recession. We're going to do that with Ed Yardeni here in a moment.
How much is a self-fulfilling prophecy, as we heard some of the commentators talk about, given the fact that really the University of Michigan sentiment surveys seem to be one of the deciding factors for the Federal Reserve to go big and to go big possibly again next month? How much are we looking, though, at a shallow recession versus a deep one? And really, that is the question that we're really morphing into.
And what's important here, Lisa, and I never understood this. I mean, I'm not a commodity expert, but they call it live cattle, but it ends up in aisle 7 in Whole Foods. Whole Paycheck is dead cattle. It's up 60% off the pandemic at lows. We had milk earlier up 66%. This is the inflation into this recession debate.
Tom, I can always tell when you've gone to the grocery store because it's sort of this renewed shock at the different aisles and how much more things have gone up. So you come in with your anecdotes about milk and about beef.
What's your anecdote? Right. What is your thing in the grocery store that mattered to you this weekend?
What I was looking at were cans of soda that normally are 8 ounces. I saw them for 7.5 ounces. Who's ever heard of 7.5 ounces? And that, I think, is that shrinkflation, this sort of small areas where you get less for spending more.
In the debate here off of our Fed show the other day, thank you folks for the comments on the Fed Decides. Really, really appreciate the guests that we had. And Lisa, what was so important to me was the Atlanta GDP number, which frankly is not a recession, but is at near the zero mark.
The reason why we keep talking about what Larry Summers said is not because we think Larry Summers is going to be right at a 5% unemployment rate for 5 years or a 10% unemployment rate for 1 year, and what the higher rates in order to address inflation lead into in terms of the jobless rates, but how much pain do we have to take to bring these prices down? We don't have a feeling that this is going to be a transitory shift in inflation, with even Janet Yellen talking about that. It's a game changer, Tom. If you're starting to talk about deliberately inflicted pain on an economy at a time when there still is a lot of wounds that have to be worked out from the pandemic.
Very quickly, Kaylee, we've got breaking news. Let's go to Bitcoin quickly. 21,000, 18 to 21,000 in the last number of hours. Is that a buy on the bottom?
Well, that's the question. The bottom maybe was hit over the weekend, if that's the case, Tom, but we'll see whether or not this is sustainable. On the subject of breaking news, you see the headline out of Kellogg?
I see that out of Battle Creek, Michigan.
3 independent companies spinning off its U.S., Canadian, and Caribbean cereal and plant-based businesses. The stock up more than 6% in pre-market.
I've had discussions over the years with Carlos Gutierrez, of course, who modernized Kellogg to a great extent about this. I mean, at the Lyons household, are you partaking in toasted cornflakes every morning, Kaylee?
My preference is Special K with red berries, and they actually have it upstairs in the pantry, Tom, if you want to check it out.
Well, we do that up in the bed, but Lisa, this is something. This goes back to 1906 in cornflakes, and there it is. They, like others, are under pressure to do something.
Yeah, try to immunize the different places. I wonder how much we're going to see other attempts to also deal with the strong dollar and how much that starts to weigh on certain companies and try to immunize them from some of the weakness in other parts of the world.
Quick data here to get to Dr. Yardeni. Futures up 65 right now, the VIX 30 level. Yields are up fractionally. I'm going to call the 10-year yield 3.27%, worth watching this morning. The real yield, the 10-year real yield, 0.67%. Some stasis in foreign exchange. I'm watching yen right now rounded up to 136. That gets my attention, 135.75. We need to do a morning brief, though, first here. It's very important that we get briefed here. What are we briefing on this morning, Lisa?
I'll whip through it so we can get briefed by Ed Yardeni, who has a lot of really important words on inflation and some of the dilemma of the moment. 10 a.m. we get existing home sales. This is expected to soften somewhat substantially as we see mortgage rates climb beyond 6%. How much does this feed into lower home prices? A lot of people are waiting for that transmission mechanism, which is not necessarily that clear-cut, given the strength of the economy and the lack of supply of houses. Today we hear from Richmond Fed President Tom Barkin, as well as Cleveland Fed President Loretta Mester. I want to hear what they have to say in terms of the unemployment rate. What will be a trigger for them to move away from some of their policies in terms of tightening? And at 7:50 p.m., Tom, you mentioned the yen. The Bank of Japan issues their monetary policy minutes from their April meeting. How much do they really look at the weaker yen as a major concern for them, given that it is something that everyone feels is unsustainable? They have a policy policy of negative yields and pinning yields where they are, yield curve control, at a time when the rest of the world is suddenly seeing the extinction of negative yields, Tom.
And now our conversation of the day on your fear of recession. Edward Yardeni joins us. He's president at Yardeni Research, but far more than that, decades of experience in the ebbs and flows of the American economic experiment. Ed, we just saw Carlos Gutierrez, Kellogg, say enough. We're throwing in the towel. We're breaking up an underperformer in Battle Creek, Michigan. In recession, in the gloom of recession, Ed, isn't the rule always corporations adjust?
Well, I think everybody adjusts in a recession. And what's interesting is if we are in a recession or we're going to have an imminent recession, as you know, Tom, this is probably the most anticipated recession of all times, which in my mind makes it either less likely, or if it does occur, it's going to be a fairly short and shallow recession, which is kind of where I'm leaning towards. At this point, I don't think a recession is yet inevitable. I've got a 45% subjective probability of a recession happening over the next 18 months. But I've been raising that assessment as everybody else has been.
Ed, let's go through some of the components, starting with gas. And with $5 a gallon gas, let's say it goes down a little bit, but stays around here. At what point is that the trigger in and of itself in terms of how much it really crimps consumer spending?
Well, you know, it's a tricky situation when you look at spending by all households. It's about 4 or 5% of all households' budgets relative to personal income. However, when you look at it on a per household basis, we were spending about $2,800 a month on average per household about a year ago, and now we're up to about $5,000 per month. And I should say that's at an annual rate. It's not per month, it's at an annual rate. In other words, at the price of $5, if it just stays here, we'll be spending $5,000 on average per household. And that hurts especially lower income households. Now, some of them have had some pretty substantial wage increases, but unfortunately, they've seen that they've had to give them all back at the grocery store and filling up with gasoline. So yeah, the gasoline situation is definitely an issue. And it's, as you mentioned before, it's really one of the main reasons that the Consumer Sentiment Index has taken a dive to an all-time record low, especially the expectations component. So consumers are depressed, and they're depressed about inflation generally and gasoline prices and grocery prices specifically.
And I'm wondering how that is going to translate into corporate earnings, because as we talk about a consumer faced with higher prices at the gas pump, at the grocery store, they are spending less on certain discretionary items. We've seen that with the warnings out of the likes of Target. How much broader will that extend, Ed, as we approach the second quarter earnings season?
Well, that's a good news and bad news situation. The bad news is that some of these retailers are getting stuck with lots of inventories of consumer discretionary categories. And the good news is that they're going to have to clear those inventories by cutting prices. And as you know, one of the most significant components of inflation over the past year has been consumer durable goods inflation. And that's going to come down, especially all the housing related items. So it's contributing to a slower economy. On the other hand, it's going to probably mean that inflation news is going to be somewhat better than expected over the rest of the year.
Ed Yardeni, given 28 flavors of recession, is your study of history that all central banks remain data dependent, or do they throw in the towel and blink at some point?
Well, I don't see a Paul Volcker out there. Let me start out with the extreme. I mean, you know, back in the late 70s, early 80s, Paul Volcker said, you know, dang it, I gotta bring inflation down. The only way that's going to happen is if I let interest rates go up to whatever level it takes to cause a recession and bring inflation down. And history does show, certainly U.S. history shows, that the most effective way to bring inflation down is to have a recession. A really hard recession will do it for sure. I don't think the central banks want to go there. They've spent the past couple of years trying to get their labor markets protected from the pandemic. They don't want to suddenly completely reverse that around. So I don't think we're going to see these central banks tighten in a way that causes the kind of recession we had in the 70s. But they are tightening. There's no doubt about that. And the fact of the matter is the financial markets have tightened even more. So credit conditions are slowing the global economy down, and I think we're going to see a peak in commodity prices here pretty shortly.
Ed Yardeni, thank you so much. Greatly appreciate it. With some real tangible optimism there. Yardeni at Research this morning. Kaylee Lyons, I just did a moving average study. And folks, I really want to make clear, we're not doing buy, hold, sell on surveillance or on Kaylee's Bloomberg crypto either. But Kaylee, I'm looking at two moving average studies of BitDog down 50-some% and another one down 20% or so. And within that study, what's amazing to me is to get back to resistance is 27,000. That's how far it's fallen.
Yeah, it's a long way away, Tom, and it's obviously not contained to just crypto anymore. You obviously saw a deleveraging in that space, but in terms of the ripple effects, Ben Emons over at Medley Global Advisors pointed to some research out of the IMF. The spillover of price volatility of Bitcoin explains 14 to 16% of the price volatility of the S&P 500. This market has ramifications across other asset classes.
We're going to continue here through the morning. Futures up 61, Dow futures up 445 to VIX 30 level, 30.34. Please stay with us. Kaylee Lyons, Lisa Abramowitz, and Tom Keene. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The world's richest person says that a recession in the U.S. is likely in the near future. Elon Musk told Bloomberg News editor-in-chief John Micklethwaite that it's not a certainty, but a recession is more likely than not. The Musk interview was part of the Qatar Economic Forum in Doha. President Biden says he hopes to decide this week whether to move to suspend the federal gasoline tax that could ease the impact of soaring prices at the pump. The move likely would require congressional sign-off and could not be taken via executive action. U.S. gas prices now average $4.98 a gallon, just short of a record set last week. Russia warns that 2 Americans captured whilst fighting for Ukraine could face the death penalty. A spokesman for President Vladimir Putin tells NBC they weren't likely to be protected by the Geneva Conventions as prisoners of war. Moscow considers the American so-called soldiers of fortune and not part of the Ukrainian army. In the UK, the biggest rail strike in 3 decades is underway. Unions rejected a last-minute offer from train companies. Some 40,000 workers are walking out today, Thursday and Saturday. That's bringing commuter services to a halt and threatening to cause transport chaos in London. And Kellogg plans to split into 3 independent companies. It will separate its North American cereal and plant-based food businesses via tax-free spin-offs. Amongst them, its global snacking business with more than $11 billion in sales. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The recession risks are going up, partly because monetary policy could have pivoted a little earlier than it did. We do have growth slowing to a little bit below trend growth, and we do have the unemployment rate moving up a little bit, and that's okay.
Loretta Mester of the Cleveland Fed, one of my favorite Fed presidents, the mathematician Loretta Mester, very good at counting the beans of recession worry across America. If you're just joining us, Kellogg, Battle Creek, Michigan, 31,000 employees, all that heritage of the American breakfast table. Did they do Pop-Tarts, Lisa? I can't remember.
I don't know. It's something that goes within the Tang and the Velveeta that you talk about every morning.
No, I do. The Tang and a Pop-Tart is one way to start the morning. Anyways, Kellogg up 9% or so.
Yeah.
They're going to split up. And Lisa, over the last 10 years, the performance is a moldy 7% per year. That's what gets it done, isn't it?
You know, please don't talk about breakfast and moldy in the same sentence. It's still 7:18 a.m. Eastern, and that's a little bit alarming to me. This is about being tax-free or having a sort of tax-advantaged units, and I really do wonder how much, aside from that, it's also looking at immunizing some of the risks from slowdowns in specific regions, because there is a huge bifurcation right now in terms of the recovery in different parts of the world.
In the autumn of 1964, the King Kitchen serving Tang and Pop-Tarts.
And everyone
My father
just got a little indigestion.
To breakfast. Someone else enjoyed that. The young Joe Matthew in 1964 joins us right now as well. Joe, David Goldman is one of my favorite people. He ran research at Bank of America, lives somewhere in the Pacific Rim, writes for the Asia Times. And Goldman is out on a blistering note about your president blaming Matthew, blaming Biden, blaming everybody else for inflation. And he says, baloney, it was a 30% fiscal impulse. The average is 20%. How does the president and how does Washington deal with pulling us away from the fiscal impulse of the pandemic?
Well, that's a heck of a question as we consider, more spending to potentially get our way out of this, and there's not much appetite for that on Capitol Hill. But indeed, we were talking about inflation long before there was anything referred to as the Putin price hike. This is something that has dogged the president for more than a year, and it looks like they're coming around with a lot of, I guess, familiar sounding ideas, Tom. The Build Back Better plan that never passed last year could re-emerge with a different brand name, with a more slimmed down look, new and improved, and might even have Joe Manchin on board. In this case, remembering that he was open to something around $1.5 trillion. It just never ended up happening. Lowering the cost of prescription drugs, maybe a child tax credit, also investments in energy is what we're talking about here. There are other ideas, though. Gas rebate cards to deal with inflation. Also, the potential for a gas tax holiday. It's interesting the language that you hear, Tom, from the White House. The president standing on the beach there in Rehoboth saying, I'm going to make a decision on that by the end of this week. But it's not really his decision. There's already been legislation introduced to do that very thing on Capitol Hill, and he needs lawmakers to approve it for that to happen. So while the White House is having its own conversation, Americans are having a different one.
I look, Joe, at the moment. Lisa, help me out here on this inflation front. It's like what to do. I mean, what do you do? It's the same in West Virginia as it is in Massachusetts, right? Inflation's inflation.
Joe, when we talk about the likelihood of things getting passed, we talked about this earlier about how there's not going to be a lot of appetite to spend more. Will there be an appetite to remove the gas tax, considering some of the pushback saying, well, then you remove the potential demand dampener and just accelerate the price increases that we see, frankly, every day at the pump?
Well, that's not something that a lot of people understand, I think, in Washington, or at least don't talk about it. Yeah, take the gas tax up, everyone takes a road trip, and now we've got even higher demand and potentially higher prices. I'll tell you another issue here, and it's the reason why Nancy Pelosi is not so much on board. She has looked back, and this was just a few weeks ago, talked about it, that it was a muted impact in cases where states, for instance, had lifted the gas tax, also saw rising demand. But here's something else. We've got an infrastructure plan that is just now being implemented to fix our roads and highways. That gas tax helps to pay for it. That's the Highway Trust Fund. So how long are we going to go without keeping our roads and bridges intact, just as Mitch Landrieu starts to comb the country, trying to make the case for the infrastructure law that was supposed to be the best thing that had ever happened? That was supposed to help Democrats in the polls this coming November, and most people forgot that it ever even happened because a lot of these projects will take years before they begin.
Well, and of course, part of what the president also wanted to spend money on was building out green infrastructure, things like EV charging stations. Where is the climate agenda in all of this as he looks to meet with big oil executives, or his team does at least, later this week?
A lot of that is in the infrastructure law. The charging stations are in the infrastructure law, as a matter of fact, and that's something that is getting money right now, where we could have, in fact, a network around the country of compatible charging stations. But you're asking the right question. How do you balance this call for more oil production while at the same time trying to transition to a green energy environment here? That's part of what we're looking at in this reconciliation bill. It would have investments in both, but I think the point here is that it's not going to happen as quickly as Democrats and progressives might want, and we're going to need a little more oil in the meantime to keep this from being such a problem.
Joe, thank you so much. This is important right now, folks. We do have markets on the move here. Futures up 60. And Lisa, as you mentioned earlier, it is the yen just within a touch of a 136 level. Dollar yen is weakened out. It's been extraordinary from 115 out to 135. And we come up here just in the last number of days, Lisa, we come up here just touching near 136, 135.90 right now. Lisa, Nora Rubini in Doha at our summit, yen weakens above 140. He looks for that to finally where the Bank of Japan blinks.
Well, to use your phrase, this is the parlor game. At what point does the Bank of Japan have to cave? An increasing number of prognosticators saying that they're not going to cave, that they can work on their own schedule, that they can control this market for a long time. The issue is they even recognize this as a risk. They even recognize that their policy is unsustainable, even as they doubled down in last week's meeting and blew out all of the people who are betting against them. How long can this game of chicken go on, Tom? And that seems to be where the yen is going.
And Kaylee, the yen seems distant. I mean, it's over there. Why do we care in that? It's about the dynamics along the Pacific Rim and instabilities, maybe bringing down the choice set that other central banks have.
Yeah, and if it's going to be a problem domestically for Japan, does that have ripple effects? It strikes me, Tom, that while we're talking about the weakness of the yen, you call it isolated, talking about isolated, the strength of the Russian ruble, which is not a conversation we thought we'd be having, say, 2-3 months ago, and yet that has caught the attention of Russian officials for a reason of too much strength, even in spite of all of the sanctions and restrictions around Russian assets right now.
I'm not going to do a compare and contrast of what is a frontier economy, as the EM guys call it. Damian Sassower would look at Russia, I think, as a frontier economy versus one of the trade and manufacturing juggernauts of modern civilization. Yen out near 136 is the headline this morning. Futures advance up 62. The VIX 30.32. Stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Bramlett, and Tom King. Mr. Farrow, well-deserved. Capri beckons, Kaylee Lines in for John today. Before we get to Romaine, we have yen moving. It's been a quiet day, and right now yen almost out to a 136 level. I believe, Lisa, a 24-year breakout to weak yen.
Highest for the dollar versus the yen, weakest for the yen versus the dollar going back to 1998. And this is a repudiation of what a lot of traders were looking for, which was a Bank of Japan humbled by a market, humbled by their inability to keep the peg, saying, no, we will. And what you're seeing right now is record weakness, at least in the modern era, Tom.
Advancing the conversation, Nora Rubini in Doha at the Qatar Economic Forum that Bloomberg had. Of course, Elon Musk there as well, talking with John Micklethwaite. And a lot of eventful stuff. Mr. Rubini is keeping his eye on 140, 140. There's a beautiful chart. On radio, it's enough to tear up. It's such a beautiful chart of weak yen this morning. On individual stocks, he's had his cornflakes. He's had his Wheaties. He followed with a 2 Pop-Tart chaser. Romaine Bostic.
Hey, good morning, Tom. I see you're on a roll today, and so are a lot of the stocks out there coming, of course, off a really awful week for a lot of these names. The most beaten down names, they're basically the biggest movers that you're seeing in the pre-market. Apple shares right now up about 2% here on the day. Schlumberger, which had actually slid more than 20% last week as part of a 7-day slide, higher by about 3%. But the conversation, as always, with a lot of these upside moves is how much conviction, how much staying power is there in some of these moves. Interesting note here on Lennar. They actually came out with earnings. Remember, this stock really got hammered last week. Everyone said that big jump in interest rates was going to have a material impact on a lot of these home builders. So far, no real effect. Obviously, a little backward looking as far as the quarter goes, but in terms of the actual deliveries, that was up by about 4%, better than expected. On top of that, the purchase price, the dollar value of all of those sales were up about 20%, and the company said it's going to stick by its full-year forecast to deliver about 68,000 homes, though some sell-side analysts already out with notes saying that's probably unlikely in the face of rising rates. Nevertheless, those shares up about 4% here on the day. You mentioned our editor-in-chief, John Micklethwaite, over there at a Qatar Economic Forum interviewing Elon Musk. Interesting commentary by Musk, of course, about Twitter. It seems to be sticking by the deal, though. As always, he has a lot of caveats about what he needs to see in order to see that deal through to completion. Shares up about 1% here, but at 38.28, well below, of course, that offer price. He also talked about his own business at Tesla, confirming those reports about layoffs and a scale down in the total amount of salaried workers, as well as some of those hourly workers. Interesting commentary. Check out that interview on the Bloomberg terminal. Also coming out of the Qatar Economic Forum is an interesting deal. ExxonMobil taking a 6% stake in a $29 billion LNG export operation in Qatar. This is an interesting move because a lot of these big oil companies now are trying to find sort of alternatives to that sort of Russian, Eastern European pipeline that they were also invested in. Now, I guess, looking to some of the Middle Eastern nations to potentially pick up that slack. And the end of an era here for Kellogg. Shares up about 8%. Of course, they trace their roots all the way back to the early 1900s, where it was a cereal maker. But of course, since then, it's grown into much more of that. It gets most of its revenue now from snack chips, which I'm sure you're familiar with. Tom, Kellogg shares up 8%, splitting into 3. And we should point out, Tom, they're going to have a cereal division. They're going to have a snack chip division. And I'm sure this will be music to your ears, Tom. They're going to have a plant-based.
Oh, they'll give me the touchy-feely vegan. I mean, Lisa, come on.
I had a vegan scramble this
weekend,
weekend, Tom.
Tang,
it was delicious.
You have the Tang with the frosted choco-tastic Pop-Tart.
You're a
but it's vegan, so it's all good.
I don't know which of the 3 companies that's in, but
it's a mishmash of Americana.
Frosted choco-tastic. We should make clear, folks, that Tang is not a property of Kellogg of Battle Creek, Michigan.
Or Bloomberg
Bostic,
Surveillance.
thank you so much. We're the close this afternoon with a report on how Kellogg will move forward. Here's what you need to know, and I've been screaming about this to Lisa's angst. She says, Tom, shut up. Put a cork in your mouth. There's a bond bear market. We love equity, stock market, equity, stock. But when price goes down in bonds, there's a thundering silence. Winnie Caesar has lived this as global head of credit strategy at CreditSize. Winnie, it's real simple. On a blended corporate index, I'm down 16%. I'm down 21% annualized. Is that a bond bear market?
It certainly feels like a bond bear market to a lot of investors, but we're also seeing a pretty attractive reset in yields, which is actually getting a lot of attention back into the market. where we have investment grade yields that are now above where they were for the peak COVID volatility in March of 2020. So that income generation property is feeling a lot better right now, despite those really terrible total returns so far this year.
Which is a reason why, Winnie, why I'm not surprised that you're seeing so many more inquiries from investors. What are their main questions in terms of the parameters of risk and the stress case for some of these names?
So the number one question is, does the U.S. or the broader global economy go into a recession? And if so, what does that recession look like? Is it severe? Is it drawn out? Is it more shallow? Is it more of a reset based on growth expectations that are not quite as optimistic as perhaps where we had been during very easy monetary policy and that COVID-driven growth? So everybody's trying to handicap what does the actual outlook for things like downgrades and defaults, because that's where you're actually going to start to see some capital lost in the investment grade and high yield market actually look like, or are we going to be able to kind of muddle through because fundamentals heading into this slowdown are actually in very good shape overall.
So given your fundamental analysis, Winnie, what have we priced in already, given yields at 8.5% for junk and for investment grade well north of 5%?
So what we're pricing in right now is a much more normalized outlook for things like downgrades and defaults. At almost 5% for investment grade, that's very much an attractive kind of income generation and also compensates you for some credit risk in terms of downgrades. We also have a much longer duration in the investment grade market, which is playing a little bit of complication into valuations, because much lower coupons means that bond prices have to fall a bit more to get you to that higher yield. In the high yield market, we have a distress ratio, so issuers that are kind of stressed, perhaps facing some economic challenges in the future, that has risen, but not necessarily risen to a level that coincides with a massive uptick in defaults overall. And so we're really pricing in kind of a more normalized default environment, call it the 2 to 3% area over the next 12 to 24 months.
So Winnie, is essentially what you're saying that we're not going to see enough stress within credit markets that the Fed presses pause or at least takes its foot off the accelerator?
I think that that's probably a fair assessment, at least for now. The Fed is very focused on whether or not capital is flowing into the credit markets when issuers need to raise that capital. And so far what we've seen is issuers are able to come to market and price deals. Now these are at much higher coupons or borrowing costs than last year, but deals are still getting priced fairly efficiently. And instead what we're seeing is that most issuers have done a really good job of pushing out maturities, of locking in really low coupon debt last year in the second half of 2020, which means that there's a little bit less to do on the issuer side of things. And that gives the Fed a little bit more air cover to continue to tighten policy.
So what are your expectations for issuance, considering how we saw so much of it over the low rate pandemic area? But as you say, borrowing costs are now higher. How many more companies are going to want to come to the debt markets?
So for the next 6 months, we are expecting that issuance is going to slow down compared to the first half of the year, especially in investment grade. That's a very typical seasonal pattern. We tend to get a little bit slower back half than front half. And this year, what we saw was a lot of financials-driven issuance in the first half of the year. And most years, most of those financials-aligned issuers actually price the big bulk of their new issue in the first half of the year. In the high yield market, I think that the borrowing and new issue is going to be a little bit more dependent on what happens with spreads and yields. For right now, the bulk of higher rated, so double B high yield issuers, they have very little to do. And it's more on a kind of need to borrow basis that we're going to see the single Bs and triple Cs come to market.
Kaylee, got to run with the breaking news. Winnie Caesar, Winnie, Kaylee, I'm sorry, brain freeze. I was thinking about Chuck-tastic Pop-Tarts. Winnie Caesar, thank you, at Credit Sites as well. Lisa, we are through 136 on weekend. 2 standard deviations out is 137.94 on its way to Rubini's 140.
How much is this a reassessment of how far the Bank of Japan is willing to go after they surprised on Friday by not giving any nod to the pushback they're getting from people in the FX market, even though you saw short bets on the Japanese denominated, yen-denominated bonds. You saw the short positions rise to the highest since 2013.
Right.
Everyone's betting they're not going to be able to handle this. They come back, they slap back the market, and this is what happens. People say, no mas, I don't want to hold it.
And I think what's so important here, Lisa, we need to explain why international economists, whatever flavor, link together euro, dollar, yen, because we go yen, why does it matter other than Toyotas? And the answer is it's way bigger than that.
It's way bigger than that, both as an economy as well as a bellwether. Yeah. It has been traditionally a haven currency for the entire global market. For this to fall out of bed because there is two different realities. There is the reality of the Europe and the U.S. monetary policies where they're saying we have to give yield because we have inflation, Houston. And then you have over in Japan saying, well, it doesn't really matter for us. And this isn't the inflation that we want. And oh, by the way, we can hold it at zero or below and it doesn't matter.
I've been out of touch on this, folks. I mean, I really dropped the ball and surveying. Fortunately, my team has researched this for me this morning. Kaylee, I wasn't even aware with Kellogg's up 8% that they've appeased like the vegan Kaylee crew with unfrosted blueberry Pop-Tarts. That's un-American.
For the record, Tom, I am not vegan. I enjoy meat and cheese and egg products just as much as anyone other non-vegan.
Brooklyn pizza, you'll do fine.
I do love some pizza, now found in Brooklyn, Tom. But of course, as you see Kellogg splitting into these three different businesses, they're talking about how in part this is a reflection of the fact that they are no longer just a breakfast cereal company, that they've expanded into different categories like snack foods, things like that. I do have to say, why didn't they name the three businesses Snap, Crackle, and Pop?
That's so cute. Lisa, I mean, she's just, her research. You know, what you guys don't understand, Kaylee Lines has comedy writers like Jimmy Kimmel. I mean, it's amazing how she comes up with this stuff this early in the morning. I could never do that. Futures up 63, they advance. The VIX 30.36. We're watching yen 135.97. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has reiterated that a U.S. recession is not inevitable. Biden spoke to reporters after a conversation with former Treasury Secretary Larry Summers. Summers says there's a significant chance the U.S. will find itself battling stagflation. In China, the coronavirus outbreak is shifting to its south coast. A flare-up in Shenzhen has triggered mass testing and a lockdown of some neighborhoods. Meanwhile, gambling hub Macau is racing to stop its first outbreak in 8 months. Bloomberg's learned that the European Union's 27 members are set to formally grant Ukraine candidate status later this week. That is a highly symbolic step on the long path to becoming an EU member. EU leaders will discuss Ukraine's membership bid this week. And Elon Musk says there are still a few unresolved matters regarding his proposed acquisition of Twitter. He told Bloomberg News editor-in-chief John Micklethwaite at the Qatar Economic Forum there is the question of whether the debt portion of the deal comes together and then whether shareholders vote in favor. Musk is still waiting for a resolution on the matter of how many bots are on the platform. And it is the latest move in the battle over who will end up owning Spirit Airlines. JetBlue has raised its offer to buy the bargaining carrier, valuing Spirit at about $3.7 billion. That follows Spirit's decision to delay a shareholder vote on its pending deal with Frontier Airlines. That vote is set for June 30th. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
that diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Often in the news recently, Mr. Musk of Tesla, SpaceX, maybe of Twitter, I'm unsure on that. He in conversation today at an incredibly important forum. It is the second year of Bloomberg committing to support of the Qatar Economic Forum. Simply put, Qatar is different. You hear of Saudi Arabia, maybe the United Arab Emirates and all of the Persian Gulf. Well, the reality is Qatar is front and center, particularly for LNG, which is why we've had conversations there with the leadership of ExxonMobil and Shell as well. Joining us now after his conversation with Elon Musk, John Micklethwaite, who we know will be back in Qatar when England goes to the World Cup. Jamie Vardy leading the way. What is the likelihood, John, that Jamie Vardy can get back out of Lister and help England not embarrass themselves?
I agree with you. That is the single biggest question of this morning. And my hope is, of course, that he will re-emerge. But seeing he's almost as old as you and me, he does face issues in that.
And of course, Bloomberg Surveillance looks forward, Mr. Micklethwaite, to attending the World Cup meetings. I think I could speak for John Farrow. Elon Musk
I think we should all go.
Yeah, we should. Elon Musk with a conversation, I would say, John, by rote. He was very careful. Why was Elon Musk so careful in his answers to your questions?
I don't know. I think what's interesting was he did it at 3 a.m. in the morning, your time, which I know is probably just only shortly before you get up. But for most of us, it's quite late in the evening. And but he was. I think he was careful partly because the topics of his life are quite careful at the moment. He has the Twitter issue where I think he's stuck between the fact that he talked about it very much as someone who'd almost bought it. He talked about things he wanted to do with it and all those things, but I can't believe that the price isn't a significant problem for him. I think he's also got issues back at Tesla. There's this issue of layoffs there where he has to be rather careful because there are lawsuits coming in. And then he's got all the politics where he's sort of come out in mild support of DeSantis, but I don't think he's really thought through that much about what he's going to do. So actually, weirdly, for someone who enjoys being a provocateur, I think he's sort of he's in one of those phases where he's sort of stabilizing a little.
Well, and John, there also is this awkward moment where he has to talk about layoffs, job cuts at Tesla, talking about 3.5% of a reduction across the entire workforce and a 10% cut in salaried workers. How much does this indicate a slowdown in the company's revenues and their manufacturing and demand?
There must be something there. I mean, he tried to explain it along the lines that Tesla has grown very, very quickly. But I think there is a sort of risk there. You played the bit at the beginning where he asked, I pointed out that Biden yesterday had said that he didn't see a recession as inevitable. And Musk effectively said that he saw it as likely. And so I think that is in the back of his mind, like it is in the back of just about everybody who runs a large business. And on top of that, he's got problems to do with China. I think that's another reason. I think Tom's description of it is quite a good one, is that I think he is careful. If you own Twitter, what does that do with your relationship to China? In the interview, he points out correctly that Twitter is not kind of allowed inside China, but the Chinese on the whole don't tend to be great lovers of free speech, and Twitter is nothing if it's not free speech. And so I think that's another set of issues for him. If he backs DeSantis or indeed Trump even for the presidency, that would cause real problems with the Chinese, and so on and so on. So I think there's a set of issues that are looking a little bit more difficult for Elon at this precise moment, though you might point out that if you start any of those things from the position of being the world's richest man, then perhaps you're not starting from a bad position.
Well, and John, on the subject of Twitter, which of course has been a topic of conversation for months now, a saga that is still ongoing, did you get the sense that he has as much conviction or passion or desire to ultimately own that company as he once did, just tone-wise? Is this a man that still wants to buy Twitter for $54.20 a share?
Well, that's the interesting thing. That if you look at the sort of deal premium, though, that it would indicate that investors don't think he's going to buy it. They think that it's going to come apart because the gap is a large one, and Tom Keene has always taught me to look at those things. On the other hand, I think he mentally is already in a state where he talks about it as something that he wants to do. I think it's more the price that is worrying him. And I think he is suspicious about Twitter's numbers. I mean, he was rather careful about what he said because he pointed out again that he had legal problems. But he still wants Twitter to come up with more information. And where exactly they are on that information thing, we have people who know more than I do. But my understanding is that they haven't given him the sort of crown jewels about what every single detail of Twitter is.
John, one final question, if we could. With our commitment to the Qatar Economic Forum, within the politics of the Middle East, there's almost a triangle, I would suggest, between Saudi Arabia, the United Arab Emirates, and up the coast, Doha. Explain the position of Doha right now within the greater Middle East.
Well, Doha is in a very interesting position. I think that's a very good description of it. I'd almost say it's a quadrangle because you've also got Iran out there as well.
Yes.
And the Qataris seem to have recently made friends again with the Saudi Arabians, but they have a long history of irritating them, and vice versa. You have the Arab Emirates, with whom again the Qataris don't get on with every single member of those. And you have the Iranians off to one side. I was just talking to somebody, a local Qatari just now, and she was pointing out that there are powerful Shias inside Qatar, and again, that is something that's different. So they are the proverbial kind of small kid on the block who's trying to sort of play several things at the same time. But they do have one advantage, which, for instance, Dubai does not have, is that they do have energy. I mean, that's the reason why every single big energy provider is here, because this is still an enormous source, especially of natural gas. And if you look at what's happening in the world economy at the moment with all the worries to do with Ukraine and this idea that we're in a transition to a greener future, then anyone who talks about transition is drawn to natural gas, and that brings you back to Qatar.
It is grand theft how Bloomberg surveillance every day steals from the hydrocarbon coverage of Bloomberg News, including Javier Blas and the leadership of Will Kennedy. Stuart Wallace doing so much there as well. John Micklethwaite, thank you so much. Look for his conversation with Elon Musk in small, Musk-like portions, but also a larger view as well. To me, Lisa, the massive thing with Elon Musk is a small German shop called Volkswagen. All of a sudden, there's competition.
He's going to be facing competition from everyone, and I've been passing Tesla dealerships occasionally on my drives upstate and back, and you can see there are cars actually in the lot, which is surprising considering the backlog.
Yeah, well, you know, it's when
Field
you're
research.
age 2, you go by quickly. We will continue. We do this with dollar yen, a 136.22. This is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein,
deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Right now, the market is really oversold.
The market believes the Fed is going to strangle inflation. We have seen markets continue over the past 6 to 9 months mark up aggressively the path for their expected funds rate.
I think this is an excellent time for investors to take advantage of the carnage. It's widespread, it's deep.
We can see the peak in yield. That should be some support for the equity markets over the summer months.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Cracks deepening in the global economy as exemplified by an ever-weakening yen. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, Lisa Abramowitz, John Farrow off, and Kaylee Lyons very much in. Tom, we've got to start with the yen as we see it weaken to the weakest going back to 1998 versus the dollar.
There's always a tariff that matters, Lisa, and here it's not only weak yen, it's the rate of change of weak yen, and then the guesstimates about where does this really matter for our listeners and our viewers. Nora Robini in Doha with Bloomberg this morning looks at 140, not too far from a 136.
How much is this pushing the Bank of Japan, seeing how far they have to go, and how much does this highlight the strains that are really emerging, that are transmitted through the FX channels as the Bank of Japan keeps its thumb on its bonds?
The institution and the culture is stunning. It's not dated, Lisa. It's just so rigid in the process that is something that they're comfortable with. The Ministry of Finance and the Bank of Japan as well. And of course, the leadership led by Mr. Kuroda at the bank. And I can only say, Lisa, that there's more a breaking point than a gradual process here.
And I would argue that a lot of this depends on how much conviction the Federal Reserve has to go as far as people expect in terms of tightening. Do they have really the appetite to spur a deep and long recession? And Tom, that is really underscoring every analyst's note. Is there a Volcker, right, to Ed Yardeni's point?
Well, yeah, the Volcker part I think is overplayed, and Dr. Yardeni made very clear about that. He didn't think, the comparisons to the late 70s, early 80s are there. But I'm looking now. I'm hesitant, Lisa, to say yen plunges, but we're getting close to the use of that word here at a 136.32 new weakness moments ago.
And Kaylee, how much are we looking at examining the contours of a recession and what's already been priced in terms of the gloom of whether we're going to reach a breaking point and the cracks and this and that at a time when earnings are still solid, when you see Lennar, the home builder, coming out with better than expected earnings after losing 44% so far this year. Is there a sign with the analyst recommendations and notes that you're reading that perhaps we've peaked in terms of pessimism?
Well, that really is the question. You have the likes of J.P. Morgan, who already called for peak pessimism, peak Fed hawkishness earlier. They say that has been delayed, but actually the second half looks a lot better. And Marko Kolanovic over there saying that the recession pricing has actually been overdone, at the same time that you have the likes of Peter Oppenheimer over at Goldman Sachs saying only a mild recession is priced in, and Mike Wilson at Morgan Stanley saying for this market to properly price in the economic downturn we're going to see, the S&P needs to be lower by another 15 to 20%, all the way down to 3,000. But the earnings question, Lisa, is a good one, because if the market is this pessimistic, if people are this bearish, does that leave room for upside surprises on earnings, or could the earnings story just reinforce all of that pessimism if we don't see margins holding in there in the face of inflation?
And Tom, you know that I love gloom as much as anybody else, but the top of the market really is highlighting this feeling that perhaps you can start looking in certain spots. You are seeing a lift in both the S&P and the NASDAQ, yields up a little bit, price down in bonds, but nothing that extraordinary except for the foreign exchange channel.
Foreign exchange channel, the Brent crude 116 gives a little bit of lift as well. Moments ago, the wonderful team of the great Greg Anderson and Stephen Gallo at BMO Capital Markets model out 138 on yen and make clear it could go much weaker through 140, even higher than that. That's an important note from a team with great experience. Speaking of great experience, Megan Horniman joins us right now, Director of Portfolio Strategy at Verdens Capital Advisors. Advisors. Megan, it's my question of the day as we go into mid-year. How have you reallocated? What is the nuance that you've done in the last number of days?
So what we've been doing is looking at the portfolio and looking at some of the areas of the market that you had mentioned earlier have kind of priced in that peak pessimism. We know recession odds are rising significantly. We think it is highly likely over the next 12 months. But what is the market priced in? And we think when you look at some of the areas like the small and mid cap space and also the developed international, these parts of the market have fallen. In the U.S., the small and mid caps somewhere between 30-40%. This is pricing in a lot of that pessimism. We still think there's some room to go in those more high, mega cap technology, very high PE multiple stocks. But I think there's room if you can look within the U.S. equity market and also internationally.
Megan, you talk about buying into the downturn and avoiding selling at the lows. How do you do that in terms of what your portfolio is, how it was arranged heading into this downturn?
So coming into this downturn, we had dry powder. Last year, we knew that this market was looking frothy. It didn't have anything really to do from the economic standpoint. We did expect some slowdown in the first half of this year, but we knew that the market was frothy. So we had dry powder to work with. We've been gradually putting money to work in those areas that I mentioned. But you got to be patient. You can't look at this market on a day-by-day or week-by-week basis. If you look at history, bear markets happen. We're in one right now. If you were to enter in when you hit a bear market, that 20% decline, if you look at the long term, returns in the market are still favorable. So you just have to be patient, be aware of the volatility, be comfortable with it, and have dry powder to put to work.
How much is the optimism that you feel in terms of your purchases hinging on the idea that the Fed is not going to be able to go as far as people think, that there is not a Volcker here on the Federal Reserve, and that they're not willing to cause the unemployment rate to rise to 5% for 5 years?
So I think what the Fed's going to do and what we're going to see the recession, the way it's going to form out is just a consumer-led recession. We know manufacturing is still very necessary and needed to clean up the supply chain. So that's going to be supportive. The labor market, as you mentioned, that is still supportive. We still have a pretty strong labor market. I think the Fed's going to have to be aggressive. I think it's going to be front-end loaded. We're going to see a lot of that this summer and into the fourth quarter. But I think it's just going to be the consumer that pulls back. And if you go back and look at historically recessions, the consumer right now, they're still okay from a household balance sheet perspective. Savings have been dried up because of the rise in food and energy prices, but debt service ratios are very low. So the consumer, we think, can come out of this, but it will be a consumer-led recession. There will be pullback in certain parts of spending.
What about corporate balance sheets, Megan?
Corporate balance sheets, they've really enjoyed the past decade of very easy monetary policy. So they've restructured balance sheets. They're in pretty good condition. It's the operating margins that is very unclear right now. That's going to depend. We'll get a lot more information out of when we get earnings season starting in July, and then what they see going forward. But the margin pressure is the biggest concern there.
Do you think margin expectations are still too high at this point, with about 3.5 weeks to go until JP Morgan really kicks things off?
I do think in certain pockets of the market, like I mentioned, that U.S. large cap technology growth area, there still is probably some room for margin contraction there. But other areas of the market have really priced this in.
Megan, thank you so much. Greatly appreciate it this morning. Megan Horniman joining us with Verdant's Capital Advisors. He publishes, and it is always a note, and I'm sure you'll see this through the day. You hear it first on Bloomberg Surveillance. Lisa Bramowitz, a guy named Dalio up in Connecticut, weighs in. And Ray Dalio with a piercing note this morning: reducing inflation will come at a great cost on the edge of summers and stagflation. And he goes back to Volcker and has the language painfully squeezed and reducing spending is part of the Dalio view forward, Lisa.
This is the bear case, and people are saying that it might not get to that extreme. A lot of people arguing that it won't get to that extreme. Others saying that's what's going to be required to bring inflation back to that 2% level that the Fed reconfirmed as their goal. The issue that I have is, yes, we heard from Jay Powell, and we'll hear from him again this week, both tomorrow and the day after on Capitol Hill, about their commitment to that 2% inflation rate. But when? When do we have to get back to it? In 2035? Is that really going to cause a deep recession? Right. Or do they need to get back to it by the end of next year? Because that's going to be an impossibility unless you get some of the pain that we heard about from Larry Summers.
Kayleigh, Mr. Dalio touches upon productivity as a solution And the word so linked to that is technology. And maybe for the optimistic crew like Ed Yardeni, it's more about technology leading to productivity, which gets us out of this quagmire.
Well, but I wonder what that ultimately means longer term for the employment picture in the U.S., Tom, because we talk about it so much. Small businesses that have positions that they simply cannot fill or they cannot pay the necessary higher wages in order to entice those employees to come in the door. At what point do those jobs just go away? Do they get replaced by automation, by technology? And what does that mean structurally for the labor market coming forward, which already looked so different during the pandemic? And when we talk about Larry Summers, 5% unemployment, perhaps more over the coming years. How does that all fit together?
And Lisa, I'm triangulating. What you do, folks, with foreign exchange is you triangulate. You don't just talk about yen or dollar yen, and obviously euro yen moving up, stronger euro, weaker yen here with a 136 level. I'm looking as well, Lisa, at Aussie yen, which I think is misunderstood, whether it's Newcastle coal out of New South Wales, Australia, or it's cases of Swan beer out of Perth, Australia. The fact is we haven't gone through to strong Aussie, weak yen yet.
I just go back to the person who told you that you pronounce Perth right, Perth, and so you're going to keep saying it as much as possible to sort of relive the glory, Perth.
I hope my badge works is what I'm looking for.
But we are looking right now at a very changed dynamic. What's the pressure point going to be for the yen? What does Neral Rubini say? 140 for the yen. I don't think they want to be bullied. I don't think that they're going to say, okay, we give up, mea culpa. You know, I mean, I don't know. I'm not buying that right now.
I'm buying that we're going to give you the continued data check here with futures up 52, and we are watching the historic weak yen. This is Bloomberg on radio, on television.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk sees a recession in the U.S. in the near future. The Tesla and SpaceX CEO spoke to Bloomberg News editor-in-chief John Micklethwaite.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
The interview with Musk was part of the Qatar Economic Forum in Doha, powered by Bloomberg. President Biden says he hopes to decide this week whether to move to suspend the federal gasoline tax. That could ease the impact of soaring prices at the pump. The move likely would require congressional sign-off and could not be taken via executive action. U.S. gas prices now average $4.98 a gallon. That is just short of the record set last week. Russia warns that 2 Americans captured whilst fighting for Ukraine could face the death penalty. A spokesman for President Vladimir Putin tells NBC they weren't likely to be protected by the Geneva Conventions as prisoners of war. Moscow considers the Americans so-called soldiers of fortune and not part of the Ukrainian army. In the UK, the biggest rail strike in 3 decades is underway. Unions rejected a last-minute offer from train companies. Some 40,000 workers are walking out today, Thursday and Saturday. That's bringing commuter services to a halt and threatening to cause transport chaos in London. And Kellogg says it will split into 3 independent companies. They include Global Snacking, North American Cereals, and Plant-Based Foods. The maker of Frosted Flakes and Fruit Loops says the move will give each business a better opportunity to grow. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I don't see a Paul Volcker out there. Paul Volcker said, you know, dang it, I gotta bring inflation down. The only way that's going to happen is if I let interest rates go up to whatever level it takes to cause a recession and bring inflation down. And history does show, certainly U.S. history shows, that the most effective way to bring inflation down is to have a recession. A really hard recession will do it for sure.
Our conversation of the day on the economics that you're living. Edward Yardeni, of course, at Yardeni Research with decades of experience. He was blistering there on this compare and contrast foolishness to the era of Paul Volcker. Some housekeeping right now as you look at markets on the move. Lisa, help me here. Stephen Gallo out at BMO Capital Markets just reaffirms weak euro to 102, which I think is really remarkable. When you combine weak yen, weak euro, I think that means strong dollar.
Well, and that goes to the Ed Yardeni point. How much conviction is there for the Fed to keep going, even as the dollar continues to strengthen? And I think about what Russ Kosterich said, which was the long dollar call was their main hedge against stocks. Does that keep working, given some of the pressure that people feel if unemployment rates start to tick up, Tom?
And also yen weakness here, and it's not just against the dollar. On radio, my tie is a mess. Come on, someone on radio, help me with my tie here.
They're clamoring to help.
I know, the issue here is it's not just about dollar. Euro, yen is what the pros look at, and the fact is we're almost through to new strength there. 143.72 gets us out near that 145 level, and that's yen weakness, Lisa, dollar, euro, and I'd also mention from Sydney to Perth, the Australian dollar as well.
You did that wonderfully, Tom. Very, very good. I will just note that Paul McNamara, who's been in this market for decades, noted that on Twitter, he said, for people younger than me, in 1998, the last time we saw this level on the yen bounced back 22%
in less than 3 months. That actually required policy intervention.
That's the incoming of the day. Yeah.
And do we end up with the same kind of policy intervention?
Right.
What will it take to get there?
And Lizanne Saunders-Schwab out on Twitter with a great chart from Redfin showing the price decreases that Redfin studies in housing have really sped up. There's some at least price decrease growth in housing. To oil, Kevin Book with us, Managing Director, Clearview Energy Partners. And Kevin, I want to link in here weaker yen and the import ramifications of Japan and others, which is a research over the weekend on what Russia is doing with their hydrocarbons. They are moving it to India. They are moving it through the Straits of Malacca, up the Pacific Rim to other places, maybe to Japan. I'm not going to speak for that, to China, whatever. What part of the Russian oil movement has your attention with Clearview Energy's global perspective?
Morning, Tom. First and foremost, the amount that China is buying. It's that strong alliance between China and Russia that really shelters the Russian barrel right now. India, notable for its growth, but China for its volume. Second is that the products don't necessarily have the same home. Those are big refining destinations, China and India. So take crude there, fine, but they've got products they've made of their own. And so they don't need as much of the refined product. That just disappears if it can't find a market.
Kevin, I want to ask you all these sophisticated questions, but really I just want to know how high gas prices can potentially go in the United States, given some of the calls out of JP Morgan and the like for $6 a gallon gasoline.
Look, did you think we were going to be at 5 right now? I think a lot of people are revising their expectations. We're one hurricane or one major refinery outage away from a significant uptick on its own. With that, we have crude structurally aiming higher. If you see real insurance sanctions go into force, I don't know how price caps are going to work just yet. A little skeptical that even works in the end. And so the sanctions the EU put in place threaten to squeeze crude even a bit more before the year ends. And so now you've got crude going up, you've got risks to the refining side. $6 is not unreasonable.
So what's the pressure reliever here, given that we've heard about taxes and removing certain gas taxes, that probably won't do anything. If anything, it'll actually cause prices to go higher because it will increase demand or allow demand to keep climbing. What do you see as a policy prescription to cap prices where they are or send them lower?
Well, you just had a guest who prescribed recession. I suppose nothing solves high prices like high prices, except also slow growth. But the administration is looking at options that are really at the sort of the dwindling end of the options set. They've already drawn the SPR. They've already considered products reserves, which aren't very big. Now they're looking at things like product export limitations, not necessarily outright bans, but caps, keeping products home. That could have deleterious consequences. Yes, a gasoline tax holiday, but as you suggested, that could induce demand or at least preserve it. And ultimately, the things that could put an immediate relief in price are sort of outside of the administration's environmental comfort zone. So things like waiving air quality standards for vapor pressure, that doesn't look like something they're going to do.
Well, to that point, this is an administration that came into office with a climate agenda that has been trying to lead a global charge toward decarbonization and cleaner energy. If you're leading an oil company, why would you invest in more refineries or ramping up your production capacity, knowing that at the end of the day, people want to phase out fossil fuels?
Yeah, drill today, disappear tomorrow is not an investment thesis. One last fossil bender before America goes green and sober is not going to convince capital discipline to loosen. It is really a difficult proposition to talk about transition and also ramping at the same time.
Well, Kevin, are you predicting $6 a gallon gas? I mean, can I narrow it down to that? Lisa, I'm asking for a friend. Lisa wants to know.
We don't predict prices at Clearview. We predict directions, and we've got room to the upside.
That's his way of saying probably.
I think he said, I think we do the banner. But
maybe.
Yeah, okay. Kevin, thank you so much. Greatly appreciated. As he predicts, we're all going to be driving VW diesels here within weeks. He's with Clearview Energy Partners. But that's an important point, Lisa, that, you know, in the old days, it was a VW diesel, a Golf, as Farrow calls it. What is that? But anyways, the point is, diesel's more expensive now than gas.
Yeah, and part of that has to do with the inelastic demand. Truck drivers have no choice. They have to use diesel in the United States, and so they can't be as price conscious. It's not that people are going to necessarily give up their diesel cars. They already have, and that's a real issue.
Okay, I want you to stay with us, folks, through the next 30 minutes. We have Pooja Sriram with us with Barclays, our U.S. economist. And then I am thrilled to tell you moments ago, Dr. Thin agreed to join us. Win Thin will join us from Brown Brothers Harriman on this historic day, the weakening of the Japanese yen. Lisa, 136.14 now. That's a full figure. That's a huge move.
The pressure is building, and the Bank of Japan is trying to resist it, but the pressure is building. At what point does this become the bad kind of inflation on steroids, when they have to go out, import goods, and have to pay a whole lot more in yen for them?
Well, we will see. And many others are writing in right now. We'll continue to watch BMO Capital Markets as well. Pooja Sriram with us, the U.S. economist at Barclays. Looking forward to that on Bloomberg Radio, Bloomberg Television. Futures up 57, Dow futures up 420, not as much as earlier, but still a nice lift with the NASDAQ up 1.6%. Please stay with us. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
let's just say good morning to you. An eventful Tuesday all of a sudden. First of all, crypto. Kaylee, what time is crypto? I'm sorry. It's in the middle of the surveillance nap.
1 p.m. Eastern time.
1 p.m.
Tom,
Eastern time. Crypto 21,000, a little bit off the game
I'm
today.
looking
but
forward to it.
Nice,
Thank you. Anytime.
Nice recovery here from 17,000. Lines driving crypto down over the weekend. And we're also watching yen. Win Thin, Lisa's going to join us from Brown Brothers Harriman here on yen 136.
How much does this exemplify the stress? And I'm curious to hear what he has to say about this versus a specific story about policy divergence. Does this highlight the channels that are allowed to express some of the concern in markets about a recession and about the inability for central banks to stop from raising rates to the expectations of the market?
We'll be watching that, and of course that does mean a resilient dollar. We're going to rip up the script here with Pooja Shriram. She's U.S. economist at Barclays, but obviously with the parchment from LSE is always dollar and foreign exchange based, is a litmus paper of the system. Let's go from weak yen out to strong dollar. How does a resilient dollar or strong dollar change the degrees of freedom that Jerome Powell has?
Well, thanks for having me, Tom. A strong dollar is definitely something that is favorable for import prices. It should help in the long term to try and relieve some pressure, at least from imported inflation. So,
but President Trump would say we need to bring the dollar down to spur exports. We haven't heard that from President Biden, at least so far. I mean, give me the export side of that discussion.
Well, it's true that a stronger dollar would be slightly unfavorable for net exports, but I think the focus right now is on taming inflation pressure. So from that point of view, we think a stronger dollar
is good
is absolutely
lesser down.
Absolutely.
Well, but Pooja, going to Edward Yardeni's point, there is no Volcker. They are not going to raise rates into a recession. They don't want to trigger a recession. Is that an accurate characterization of what you expect from the central bank?
Well, absolutely. I think no central bank wants to engineer a recession. But from what we saw in their summary of economic projections, from what we heard from Chair Powell, I think they are acutely aware that there is likely to be some pain to the economy if they wish to bring price pressures under control. And I think what they showed us through the 75 basis point rate hike in the June FOMC and what their hawkish dot plot shows us is they're willing to sort of push the limit a little over here to try and get expeditiously to neutral. And even if that comes at the cost of slightly lower growth and slightly more unemployment, I think that's a chance that they're willing to take at this point in time.
All right, so if you go there to the dot plot and the projections, we have to also go to what some people have called fantasy land, this idea of unemployment remaining fairly muted into the future, even though we do have this hawkish tilt. What is the breaking point for the Federal Reserve, for policymakers more broadly, in terms of the unemployment rate at a time when you've got the likes of Larry Summers projecting 5% unemployment for 5 years needed to bring inflation down?
Yeah, it's. I think they are in a tough spot. That the trade-off between achieving price stability as well as full employment, that's becoming increasingly challenging. And I think we are in a tough inflation environment. I do agree to your point that the projections that they've laid out in their summary over there do seem a little optimistic. Some might call it a rosy picture. Aspirational even. But I think what the Fed is likely to look at going forward is how the data evolves.
Yeah.
And that's a message that Chair Powell has given us multiple times. So I think that's going to be their focus as of now.
Well, what data will they be looking at between now and July when they're deciding between 50 and 75?
Yeah, so we get a whole host of data points, in fact, between now and July. But I would say top of the list would definitely be in the June CPI inflation print. They will, see signs of whether inflation pressures continue to accelerate, across core categories particularly. The University of Michigan's inflation expectations print is going to be another important indicator that they will look at. And then, of course, we have the employment report that comes in at the beginning of the month. And, outside of that, I think they will also continue to look at some of how, some of the other data points in terms of how retail sales evolve, what's happening to housing. For example, we get a bunch of home sales data. And, we're getting the sense that housing is beginning to feel the pinch of tighter financial conditions. So I think it's going to be a whole set of these data points that they will keep an eye on. And, you know, that's what they're likely to deliberate on before making their policy decisions.
To focus in on the inflation expectations data point in particular, because Powell cited that directly in the press conference last week, saying we saw that University of Michigan number, and that is partly why we decided to move 75 basis points, not wait 6 weeks to do so. And we heard Jim Bullard of the St. Louis Fed over the weekend talking about the risk of inflation expectations running away, getting out of control. How large of a credibility problem does this Federal Reserve have right now, and what is the likelihood you place around something like that happening?
Well, I think credibility was, you know, probably an issue that they were concerned about going into the June FOMC meeting, and I think that's the reason why they did such a statement hike, and, you know, they did that hawkish shift to their dot plot. But, you know, having done that, I think to some extent they have been successful in sort of reinstating credibility around their price stability mandate. As of now, you know, inflation expectations still look reasonably well anchored. Yes, the move up in the University of Michigan print was a cause for concern, but right now that doesn't seem to be running away.
This is critical. I mean, July 27th, and Barclays says there's a reluctance to do 75 beats back to back. That puts you in you know, a less hawkish camp, I guess is how I'd put it, not so much dovish camp. How close are they to their comfortable neutrality? Not some fancy Taylor rule or statistical ballet, but how, I mean, if it's nonlinear, how close are they to the point where they're aware it's nonlinear and there's a huge impact? Is it now? Is it the fall? Is it next year?
I think they're getting there.
They're getting there.
Yeah,
okay,
they're getting there close to their, you know, estimate of the neutral rate. And like you said, we are slightly below consensus in that we are calling, you know, for a 50 basis point hike in July. And we think right now we are seeing signs that tighter financial conditions are likely weighing on economic activity already. We think that these signs are likely to intensify as we get into the July meeting. And, you know, maybe the Fed is likely to conclude that policy is possibly inching into restrictive territory already.
And Lisa, I've been remiss on this. I'm sorry, folks. The Bloomberg Financial Conditions Index, which is really, really a good series, thank you, Michael Rosenberg and team, is one standard deviation down today. It's a negative 1.06, Lisa, which is germane to the Barclays point.
Things are tightening, and you see that in mortgage rates, exemplified there probably more than anywhere else at 6%. Pooja, how much buying power does the consumer still have? One of the biggest questions has really been the power of the consumer, and we've heard about how they are so strong and their balance sheets are terrific. Are they really that good right now?
Well, to your point, yes, household balance sheets still look reasonably, you know, healthy. We still estimate that excess savings that they accumulated over the course of the pandemic are still about $2.5 trillion. But we are seeing signs that consumers are likely pulling back on spending. We think the momentum in consumption spending is slowing. We see that in the retail sales data, for example. We track some high-frequency credit card data, and we've seen signs that, you know, spending has slowed across goods and services. And then, you know, to your point, the savings rate has also dropped well below pre-pandemic levels. So, you know, even despite the fact that they do have, you know, decent balance sheets to rely on, it looks like they are becoming a little hesitant about spending, and I think eroding purchasing power is a key concern among consumers right now.
Pooja, thank you so much for joining us today. Pooja Sriram with us with Barclays this morning. Lisa, the publications right now on yen are coming fast and furious. Sarah Vellos over at Deutsche Bank moments ago recapitulates what he did, it seems like ages ago. I think it was 7 days ago. And it's absolutely stunning how the Bank of Japan is on, and it's a cliche, folks, but on original territory here. It's just stunning.
So in order to keep the yield curve control that they've committed themselves to, they've been buying an unprecedented amount of bonds. It was something like $2 trillion, or 2 trillion yen of debt at the last auction. It's meaningless. What he says is that the monthly run rate of buying by the Bank of Japan is now double the pace of buying at peak Abenomics at around 20 trillion yen of government
bonds. This, to me, really shocked me. It is the GDP equivalent of the Fed doing $750 billion of monthly quantitative easing in the United States. That is what is required to keep their commitment to ultra-low rates.
Legging up here, as Anderson and Gallo at Bank of Montreal say, BMO, right now, 2 standard deviation move weaker. Yen, Lee says, at 138, 137.96. So we're moving fast and furious.
At what point does this become the canary in the coal mine, as you said, the sort of stress? And at what point does the Fed get concerned about the strength of the dollar? What's going on, Tom?
I thought BitDog was the canary in the coal mine.
Yeah, what would that mean?
I don't know. Kayla, do we have any idea how you're going to attack crypto today?
We're going to take
canary in the coal.
Nice
are you going to interview?
Are you
going to interview the canary in the coal mine?
BitDog killed the canary.
No, we're going to take a look at the technicals here because this really matters for this asset class in particular. We've seen certain levels that were supposed to be support broken over the weekend, yet a rebound taking shape today. So what do the charts tell us about whether or not that rebound is ultimately going to be sustainable, if this is an actual bottom that is formed in the cryptocurrency market? Has enough deleveraging happened already that you aren't going to see that kind of forced selling pressure we've seen over the last week or so? All questions that we want answers to. 1 p.m. Eastern time, we'll try to get some.
Lisa, I got a bit of pushback on the Dalio comments. This is Mr. Dalio publishing in Bridgewater, stagflation. And then you see Pooja just pushing against that, just saying, no, they're gonna have to slow things down.
I thought you were going to push back from BitDog eating your canary next to your foot. No. Well, we're going to talk about that in terms of the push-pull of what the Fed's going to do coming up on the open with Kevin Holt, who's Chief Investment Officer over at Invesco. How much have we already priced in, Tom? To me, is one of the key questions.
This is Bloomberg. Stay with us. Next, we look at the Japanese yen.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has reiterated that a U.S. recession is not inevitable. Biden spoke to reporters after a conversation with former Treasury Secretary Larry Summers. Summers says there's a significant chance the U.S. will find itself battling stagflation. In China, the coronavirus outbreak is shifting to its south coast. A flare-up in Shenzhen has triggered mass testing and a lockdown of some neighborhoods. Meanwhile, gambling hub Macau is racing to stop its first outbreak in 8 months. Bloomberg's learned that the European Union's 27 members are set to formally grant Ukraine candidate status later this week. That is a highly symbolic step on the long path to becoming an EU member. EU leaders will discuss Ukraine's membership bid this week. And the blank check company Gors Guggenheim will formally merge with Swedish electric vehicle maker Polestar on Thursday. Shares will start trading on the Nasdaq the next day. The transaction is expected to raise at least $850 million in gross proceeds. And Elon Musk says there are still a few unresolved matters regarding his proposed acquisition of Twitter. He told Bloomberg News editor-in-chief John Micklethwaite at the Qatar Economic Forum there is the question of whether the debt portion of the deal comes together and then whether shareholders vote in favor. Musk is still waiting for a resolution on the matter of how many bots are on the platform. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
If the yen keeps on falling, and it's going to fall more given the divergence between BOJ policy and other central banks, at some point inflation is going to become a problem for the BOJ, and they're going to give up on that zero policy rate. If you go well above 140, the BOJ will have to change policy, and the first change in policy is going to be to change the yield control curve policy and go above 0.25 on the GPGs.
It is what we try to do each and every day at Bloomberg Surveillance. When news breaks, we can go worldwide with Bloomberg from Doha and the Qatar Economic Forum. Nora Rubini this morning modeling out 140 as weak yen is a point of breaking for the Bank of Japan. Of course, with Rubini Macro Associates and someone who's helped us out so much over the years. Helping out as well with a visual here, perfect for radio, Kriti Gupta on weak yen.
Yeah, well, if Nouriel Roubini calls for 140, Tom. Well, we're already at 136. Of course, it's the highest levels that you've seen for dollar yen going all the way back to 1998. When remember, we did have that coordinated currency intervention. When I say coordinated, I mean the United States was in on it. Europe was in on it as well. Do we see that coordinated reaction again? Here's the problem with that. Two things. One, you're looking at a $4 trillion daily turnover market. And two, you're also looking at a race to a strong currency. What's the incentive for currency intervention? Which really brings me to my chart of the day here. That's what's making traders extremely nervous. We're looking at implied volatility, 1 week implied volatility for dollar yen. For our radio audience, what you need to know is it is a straight shot up when you look at the regression from that December low to where we are now. And once again, Tom says this all the time, it really is that rate of change that matters. But Lisa actually talks about bond auctions so much in the United States. I got to bring the bond auction from Japan here, seeing their worst bond auction for their 5-year since, get this, March of 2020. If the fear is that the bond market or the JGB market is going to break, how much further can the currency really handle, Tom?
Kriti Gupta, thank you so much. He is with Brown Brothers Harriman, is head of global currency strategy, but far more, he is definitive on the international relations, his work at Brandeis and on to Colombia as well. Win Thin joins us now in the span of the Pacific Rim and what it means for Tokyo. Win Thin, I'm going to go back to a September of 1992 where George Soros made history with the breaking of the Bank of England. Who right now is trying to break the Bank of Japan?
Well, first of all, again, thanks again for having me. It's always a pleasure. I do admit that I love this 8:45 slot more than 6:30. FYI.
So does Lisa, but you know she's awake by then. Now continue.
Call me anytime. Honestly. Anyway, here's the interesting thing. It's the markets are testing the Bank of Japan yield curve control as opposed to the currency. I mean, the currency is obviously a byproduct of this whole system. But we've been hearing reports, obviously covered by Bloomberg and other financial reporters, that a lot of hedge funds are going short JGBs on the assumption that the Bank of Japan cannot hold the yield curve control. To me, I think they can sustain this. I mean, I said this, I think, on my last appearance a week or so ago, is that, if there's dislocations in the JGB market, some arbitrageurs and speculators, get dislocated, I think the Bank of Japan is going to accept that. The Bank of Japan right now is getting two things that they've been trying to for decades, and that's a weak yen and higher inflation. And I think if you look at the official comments, especially from Governor Kuroda, they don't want to pull the plug early. Any sort of reversal on this easy monetary policy could easily see the dollar yen fall 10, 15, 20 big figures. It's anyone's guess. But that is the real fear from the Japanese policymakers, why they are maintaining the current policy.
Okay, so if we don't see a policy shift from the Bank of Japan or other sorts of intervention, is there a path to a stronger yen, an alternate scenario?
Unless they change their monetary policy stance, I think it's a one-way bet. Again, I keep bringing this up, but I admire Professor Robert Mundell so much. But his work back in the 60s, this is during the era of fixed exchange rates, but he basically had set forth what he called the impossible trinity. That is, a country cannot have open capital flows, independent monetary policy, and target the exchange rate. And as long as the Bank of Japan continues to run ultra-loose policy, this monetary policy divergence is really the major driver across most FX markets, particularly here for dollar yen. And that's the thing. They had a chance last Friday to make a statement and perhaps step back from this, but they went double down pretty much and went full in on this. And they can't be surprised that dollar yen is up here. This is again the natural byproduct of their easy money policy.
Okay, so if we widen it out and look at Asia more broadly, how, for example, is Beijing likely to look at this weaker yen?
Well, actually, it's funny you bring that up. Interesting, because if you talk about monetary policy divergence, I think that's another story with the People's Bank of Japan. They're actually in easy mode. Bank of Japan is in easy mode, but sort of staying steady. But People's Bank of Japan is actually easing. So to me, that's another signal for dollar yen to go higher as well. This is, again, a natural byproduct, and that's something I think we'll continue to see.
When we're out of time, we've got to get you back here to discuss this. And of course, we do it with many on the street looking for continued weakness in yen. Dr. Thin is with Brown Brothers Harriman in New York. Kaylee, I got 18 things to talk about, but I got to pitch the crypto show. Tuesday, today, is Matt Miller in the building? Is he going to be with you on this, Kaylee?
Of course he is. 1 p.m. Eastern time. He'll be joining me. We have a lot to discuss today, Tom.
Do we have a why it went down this weekend? I mean, it's not like Kellogg's where it goes down or goes up because they have a press release. Was there a press release that moved BitDog down this weekend?
It's always hard to understand the drivers in this asset class in particular because it is historically so volatile, and clearly that isn't something that has changed recently. It's actually become more so. But a lot of the conversation was that this was forced selling taking place, that you saw one event happening in May with the collapse of Terra USD, then you saw Celsius freezing holdings, add on the broader macroeconomic environment of tightening policy, of money no longer being freed, liquidity being less abundant. All of that caused a lot of selling pressure. The question is the rebound we're seeing over the last... Good question. I bet he does. Jay-Z's in on crypto as well.
Specifically why did
financial.
I know that?
No, he and Jack Dorsey actually are bringing financial education about Bitcoin to certain housing projects. So that financial literacy conversation, obviously something entirely different. But yes, Tom, to your point, there's a lot of big names and evangelists in this space. By and large, the faithful stay faithful.
Tell me Ed Sheeran's not into crypto.
That I don't know, Tom. You should ask him. See if he'll come on the show to talk about it.
Well, crypto. This is what, an hour program, or do you go out 2 hours at extended crypto?
It's only 30 minutes, but if you'd like to talk to management about extending it and be an advocate, be my guest.
I would be an advocate for that. Seriously, it was really interesting to see. I watched the move to 17-ish this weekend, like I watched the end of Lehman Brothers or Bear Stearns. Every tick was absolutely fascinating on the Bloomberg. Crypto right now, BitDog rather, I call it tulip coin, I'm sorry, 21,084 on Bitcoin, and you could see it and believe it on crypto this afternoon. Please stay with us, an eventful day. Japanese yen weakens.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow with an optimistic green tone ahead of the Open. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue, recession calls gaining momentum.
Risks are clearly growing. It could be a pretty significant slowdown, becoming increasingly amplified.
Basically, will be one of a recession by the end of this year.
A recession is somewhat inevitable.
More than likely,
risks that we move into recession are going to be increasing.
More pain to come in broader markets.
Wherever we look in terms of our indicators, they all look pretty recessionary for the next sort of 3 to 6 months.
Everybody's waiting for the recession. It's a simple debate. It's hard to figure it out. Is when does the recession start?
Where are we on the risk of the hard landing?
How hard of a landing can the Fed and policy change really create?
The Fed has no choice. Keep on tightening, even if that's going to lead to a hard landing.
I'd know when to ditch the boat. I daren't ditch it now.
The chief concern for the market, for sure, is that central banks will tighten their economies into recession.
After listening to that, you might want to crawl back into bed. However, we do see futures up and a little bit more optimism baked into some of the notes that I was reading over the weekend. Joining us now to discuss Eagle Asset Management's James Camp and Julie Beal of Kane Anderson Rudnick. Julie, I want to start with you. Have we baked in already the prospect of a recession, and is that why we're seeing perhaps hints of optimism now?
No, I think we still have quite a ways to go in terms of movements towards the recession. And that's quite simply because we don't know the depth or the severity of what may be coming towards us, right? It's hard to know exactly where the consumer is going to end up because that's really the economic engine for the U.S. economy. And, the consumer has really taken it on the chin the last probably, half year. And I think trying to understand how much resilience the consumer is going to have and how much job increases and wage growth is going to maintain is key to understanding the depth and the breadth of the recession.
So Goldman now seeing a 30% probability of recession over the next year, at least in the United States, with Jan Hatzius writing, quote, "We now see recession risk as higher and more front-loaded. We are increasingly concerned the Fed will feel compelled to respond forcefully to high headline inflation and consumer inflation expectations if energy prices rise further, even if activity slows sharply." James, do you agree that there is enough conviction within the Federal Reserve to pull a Volcker, to go even if they see the inflation data perhaps coming down, but in tandem with the unemployment rate going up?
Lisa, I think so. I think the Federal Reserve has been caught dramatically off guard or off sides, if you will, in terms of policy response, at least in terms of timing. This has bled into the political issue. As we know, inflation is the largest regressive tax you can layer onto an economy. And all the signs point to the Fed being much more active and really slowing and tightening credit conditions in aggregate, even more so than just moving short-term interest rates. We're seeing a lack of bond deals coming to markets. We're seeing IPO add-ons or equity add-ons not coming to market. This is a capital market slowdown of consequence, and it is a complete recasting of the fight that we have not seen for multiple decades. And the Fed has to be aggressive and destroy demand, which brings you to your recession question.
James, do you agree with Julie that it's not been baked into valuations yet?
No, I don't think so. I think we have room to fall in risk assets, and that's the unfortunate consequence of this. Part of the conversation, though, is this deleveraging effect that inevitably follows massive monetary easing. And we see it across asset classes. When you see year to date really nothing working, that is a sign that we're having sort of a deleveraging moment in capital markets, which will play itself out, but it's going to take some time. So credit conditions are getting very, very tight, and risk assets are going to be under significant pressure for the next couple of quarters.
And underpinning this kind of call is what former Treasury Secretary Larry Summers said over the weekend, or actually yesterday, talking about what could curb inflation, saying, quote, "We need 5 years of unemployment above 5% to contain inflation." In other words, we need 2 years of 7.5%, or 5 years of 6%, or 1 year of 10% unemployment. The numbers are remarkably discouraging relative to the Fed's view. Let's bring in Bloomberg's Michael McKee for more. Mike, we've been talking about this, with some calling the Fed's projections fantasy land. How realistic is what Larry Summers is saying?
Well, it's Larry's calculation of what it would take. He's obviously not advocating that millions of people be thrown out of work, but if you're the Fed and want to get inflation under control, he thinks it's going to have to be something like that. Although he told President Biden yesterday that he didn't think we needed necessarily to have a recession. And we don't have one right now, at least according to the NBER indicators. They are, of course, the arbiter of recessions. And you look at the incomes, employment, consumer spending, they're all still at least on path, if not still rising. And therefore, we don't think we're in recession now. The guess is that you don't really know when you're in recession until after the fact. And these people, you mentioned Goldman earlier, are already calling for a recession or saying a recession is very likely given the situation that we are in right now and the fact that the Fed is going to have to be aggressive. So later this week, what are we watching? We're watching some indicators that might give us some information. And of course, we are watching Jay Powell. He is testifying up on Capitol Hill to the House and the Senate, and he'll be offering his view on how aggressive they need to be. But look at existing home sales today. And then, of course, on Thursday, jobless claims, they'll be the canary in the coal mine for employment. And then the Michigan numbers, we don't focus on this a lot, but the Fed did the last time they came out because inflation expectations jumped. And that, Jay Powell said, led them to the 75 basis point move. We'll watch and see if that changes at all in the latest iteration of the numbers, Lisa.
Michael McKee, thank you so much. We still have James Camp and Julie Beal with us. And Julie, you were talking about how you do not think that it is priced into the market that we're going to face off with some recession. Are you actively shorting certain stocks, since I do know you run long-short strategies, or are you just refraining from buying?
Well, typically when we short stocks, we are taking a long-term view on something that's in kind of a secular downshift. So a good example of that would be something like office supplies. But, you know, in the near term, we do see a real opportunity on the retail side, because if you think about what's on a boat right now in Long Beach, it was something that was ordered some 6-9 months ago when oil was a very different story. And so I think we're going to see a real tsunami of inventory hitting our shores, and that's going to really kill the back to school and holiday season. So retailers are definitely a place we would be avoiding, even though they've really taken it on the chin. I think we don't know what the earnings bottom is for that sector and how they're going to recover.
Julie, we were speaking with BlackRock's Russ Kostrich earlier this morning, and he said that the best hedge against weakness in equities right now is long dollar. Is that your case as well, or is there something else that seems to be reliable, the sort of conservative play?
You know, for us, we're always focused on quality businesses because we're trying not to do too much forecasting of how, you know, the U.S. economy is going to turn out, right? Who could have predicted COVID? Who could have predicted this war? But they're all having serious impacts on the economy. So for us, we try to find businesses that can just weather through these kinds of storms. And it's really important to think about fundamentals in terms of business models. The most resilient types of business models are things that have network effects. So like a Market Access is a great company that can be really well positioned, even if we have a serious downturn.
So meanwhile, we're looking, James, at a situation where some people are actually starting to go back into bonds. What's your view on that? I know that PIMCO, for example, this morning, Mark Seidner came out and said that bonds are actually suddenly attractive again.
I think absolutely. I think we're in a peaking process in the 10-year Treasury. We're now at least double the yield on the S&P. So for income investors, for our multi-asset class income strategies, we are leaning more into the bond market than we have over the last decade. We still like a lot of the dividend plays. We like a lot of the earnings. And as your prior guest mentioned, quality businesses, pricing power, all of those things. There is a change, I think, in terms of where investors are going. Value, income, you know, proof of earnings, proof of free cash flow. But the bond market is looking to us to be a very attractive, certainly a much better entry point than it has been for the last couple of years. And just to remind our viewers, 0.40 basis points on the 10-year Treasury just a little over 2 years ago. So these 3.5% yields, actuarially speaking, in long term, you add on a corporate credit spread that has widened, you know, you're getting 4.5–5% yield for an asset class that has been out of favor for a long time, and it's time to take a good hard look at that.
Although the counter argument to that, James, this is something that's the concerning point for a lot of people, as if inflation takes off. St. Louis Fed President Jim Bullard was weighing in on the current inflation picture, saying, quote, inflation expectations could become unmoored unless the Fed takes credible action, and if we didn't do that, we could get a new regime that would look more more like the 1970s, then you'd have high inflation and volatile real economic performance. It is definitely not something that anyone wants to see. But James, how much is this a risk case for bonds as you go into them, especially given the fact that a lot of people question the Fed's resolve to really spur a recession?
Well, first and foremost, Lisa, I think that the Federal Reserve is on this. This is late, but they will be probably overly aggressive. I think secularly, demographically, and globally, we are still in a secular downtrend or moderation in interest rates. So I would disagree with the former Fed governor. The other part of this is if you had perfect foresight coming into 2022 and you knew inflation was going to spike, that was our base case, that we were going to have higher and more stubborn inflation, and you bought something like Treasury inflation protected securities, you were down in the worst market for TIPS in 20 years. So the point is you have to be very judicious in what you select, the names that you select, the asset allocation that you make, and to sort of be cuter by half and try to get in front of some of these trends with products that don't necessarily work probably is going to be counter to the investor's best interest. I think inflation secularly comes down in the next 18 months, but it's going to be a very difficult few quarters.
Julie, how much are bonds an offset to potential equity risk right now?
Well, I mean, I think we still have some ways to go in terms of the equity risk premium contraction. And I think for us, it's hard when you are facing this much inflation to be looking at, certain instruments that haven't really been working. So, as an equity investor, I'm always going to say buy equities. But I think, thinking about inflation and how it plays out, for us, we're more focused, obviously, on small and mid-cap stocks. We think that domestically focused businesses are going to be better protected in what I think will be global recession.
We have more on that coming up. Julie Beal and James Camp, both of you are sticking with us right now. Let's take a look at the stocks moving ahead of the opening bell. Abigail Doolittle here with some details. Abby.
Well, Lisa, what a difference a long weekend makes, because we certainly do have a nice relief rally. And even with yields higher, we have big tech rallying. That means the likes of Apple and NVIDIA, some of last week's biggest laggards, up sharply, up 1.6%. And UBS supporting Apple, saying that China iPhone checks look pretty positive there. The chips were hit really badly last week, a nice bounce back. Tesla up 3.3%. This is the company is even cutting salaried positions by 10%, reducing the workforce overall by 3.5%. You have to wonder whether or not this is the beginning of hearing of broader layoffs among companies. And then finally, Spirit Airlines popping once again, up 7.9%. This is JetBlue, really wants that Airbus fleet of planes. They've upped their bid by $2 to $33.50 per share, nearly $15 above Frontier. So even though Spirit, they have said that there are stronger synergies with Frontier, it's such a widespread to that Frontier bid, it's hard to ignore, Lisa.
It's a fascinating story, Abby. Thank you so much. Coming up, the White House remaining laser focused on lowering prices for U.S. consumers.
President Biden wants to do anything he possibly can to help consumers. Gas prices have risen a great deal, and it's clearly burdening households. So he stands ready to work with Congress.
President Biden preparing for yet another meeting with big oil this week. That conversation coming up next. We are seeing momentum heading into the open. The S&P futures gaining 1.6% now as we're just moments away, about 17 minutes away from the open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Talking about price caps or a price exception that would enhance and strengthen recent and proposed energy restrictions by Europe, the United States, the UK, and others that would push down the price of Russian oil and depress Putin's revenues while allowing more oil supply to reach the global market.
The U.S. working with allies towards capping prices on Russian crude exports as President Biden nears a decision on suspending the U.S. gas tax. Take a listen.
That's what I'm considering. I hope I have a decision based on data I'm looking for by the end of the week.
Bloomberg's Anne-Marie Hordern joins us from D.C. for more. Anne-Marie, how realistic is this, considering some of the pushback and the criticism that it will actually increase the cost of prices by allowing demand to simply accelerate?
Right, because what you need right now in this market is demand destruction, and potentially this could increase that. Listen, Lisa, this is going to be very difficult because the administration, if they decide this is the route they want to go and they're trying to do really pull any lever to bring down the cost of consumer prices, most notably gasoline, which is key to household budgets, they're going to have to get congressional approval on board. And we already heard from Senator Mitch McConnell back in February when this was floated that he said this would have too much of a hole in the infrastructure, highway debt. That's where the money would come from. And he called it political games. Even individuals within the Democratic Party. We heard from former Secretary of Treasury Larry Summers just on Sunday talking to NBC saying he thinks it's a gimmick and that at some point you're going to have to reverse this. But when you have inflation this high and gasoline, the average right now is just a smidge under $5 a gallon, this is politically debilitating inflation. Right. And so the administration has every card on the table.
Anne-Marie, I know that you feel this way too. It's like Yogi Berra said, deja vu all over again in terms of the conversation that we've been having over the past few weeks. But has there been a shift in the administration's tone when it comes to how to handle the industry, fossil fuels, in terms of what their project is in legislative attention to inflation, talking about support for both the renewable and the fossil fuel industries?
Well, on one hand, we do know the administration is also working with Congress right now to try to bring back some of those provisions that were initially part of Build Back Better, and they're really re-signposting it as this is a way to fight inflation. Potentially some climate provisions could be part of that, because really the overarching theme of this administration is, yes, we need fossil fuels right now, but longer term, we want to move towards renewables and a more sustainable way to get from points A to B, right? Move our cars, heat our homes. But Lisa, you bring up a good point, because there has been a shift in tone in the sense the president wrote this letter asking the oil industry to do more, asking for refining capacity. And then this week, we have Secretary of Energy, Granholm. She'll be sitting down with those executives. So I would say stay tuned to what comes out of that meeting and whether or not the industry potentially wants to come help this administration out.
Bloomberg's Anne-Marie Hordern from Washington, D.C. Thank you so much. Standard Charter's Bill Winters, seeing an oil shock, and he warns that prices could still go higher. Take a listen.
I'm not a oil price forecaster, but could it go higher on the back of either further restrictions, further embargoes, or ongoing underinvestment? Yes, it definitely could. The markets will equilibrate over a period of time at a price probably a bit lower than where we are right now, because this is a demand-destroying price over a period of time. In the short term, though, we're very vulnerable.
James Camp and Julie Beal still with us. There's an issue, Julie, about whether all of this potential increase has already been baked into the price of some of the oil majors. Do you think that that's the case, that it's sort of overvalued at this point, or that there's more upside as we do see the pressure mount?
I think it depends if you're talking to a long-term or short-term investor in terms of how well positioned they are for the next 5 or 10 years, in terms of, do they finally start to boost their capex and take advantage of this declining resource, or are they going to continue to be positioned to just maximizing profitability in the short term? Because the thing that we don't know about for all of these oil companies is what the price is going to be, and what the long-term impacts are going to be of a protracted war. Is this going to change the power mix, the energy mix for Europe? These are all really big questions, and I think it's, if you think of the fundamentals of these oil and gas companies, when you are completely beholden to price to drive the economics of your business, it's very hard to plan. That's why we typically don't invest in this sector.
James, what about you? Do you think that it's the inflation hedge, as many people have pointed to over the past 6 months?
Well, I think Julie hit the nail on the head with energy. It's a very hard business to plan. It's very hard to plan around a commodity price that's volatile. I think it's going to stay elevated for a long period of time, however, given some of the political decisions that have been made on permitting, refineries, and the like, and obviously the war. As an inflation hedge, frankly, I think when you look at consumption, if the companies and the things that you buy, if those you find the best quality in those sectors and you participate, for example, some of the foodstuff type of companies, if you buy their equity with a growing and compounding dividend, if you look historically, you outpace the purchasing power degradation of inflation by simply owning good shares of companies that participate. They're much more easy industries to forecast price and price elasticity than energy. But I do think the energy overhang, the albatross, if you will, is going to be with us for a while. And I don't see a lot of relief. And certainly the political sort of tinkering, if you will, or sound bites are not going to move the needle in terms of getting energy back online domestically. There's some serious questions and some serious policy decisions that have to be made if we really want to go back towards more of an energy independence idea with fossil, and we're not close to that right now.
James, how much of a support is this to credit in a way? Because if you look on the riskier spheres of the spectrum, a great proportion is tied to energy companies, which are being supported by where prices are right now.
Well, I think there's many good areas in the energy patch to invest, either in the debt or the equity. You have to be judicious and careful about where you go. Obviously, you don't want companies that are singularly levered to the price of a barrel. But right now, I think there's better opportunities in energy than there have been in a while. They've been a good performer year to date. We're certainly not massively overweight. But as we see this regime change, and that's exactly what it is, and commodities generally across the board higher, it's a fair place to look, at least for the next handful of quarters.
Julie, just really quickly here, I'm wondering if you see the potential going forward for other sectors to get hit harder than people expect because of where gas prices are right now.
I think to me, retail, it continues to be the space. And then I think as we pass through the summer season, we're going to see a softening in the leisure space. I think we're all going to have a great summer. We're all going to go on the trips we've been wanting to go on for 2 to 3 years. But looking forward, I still think that demand across retail, across leisure, is going to be quite soft, because I just don't think the consumer really has the power to sustain us over many years.
Our sincere thanks to James Camp. Julie Beal is sticking with us. Coming up, the morning calls, and later Lennar providing some relief for beaten down home builders. Invesco's Kevin Holt joining us with his outlook for housing. With earnings season underway, that conversation still ahead. We are seeing a sustained lift, actually gaining a little bit into the open and trying to rebound after some of the catastrophic losses that we saw in specific names last week and in the past 6 months. From New York, this is Bloomberg.
at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Credit Suisse upgrading ExxonMobil to outperform, expecting the company's growth strategy to deliver excellent returns. Next up, UBS upgrading Charles Schwab to buy, highlighting the stock's enticing, attractive valuation. And finally, Cowen downgrading Under Armour to market perform, cutting their price target to a street low of $10 amid lingering macroeconomic uncertainties. Coming up, Invesco's Kevin Holt joins us for the opening bell. From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, and we do see gains across the board, maintaining a 1.6% gain pretty much in the NASDAQ and the S&P. But you can really see the strength in the dollar as where the strength and the momentum really lies. You're seeing yields a bit higher, but really the dollar strength pervading throughout the entire complex, whether it is Japanese yen or whether it's the Aussie dollar. You are seeing a euro with a little bit of strength, but what I'm looking at right now is the yen breaking down to the weakest level going back to 1998 as we look at that policy divergence really getting called into question with some of the traders pushing back against that and saying, okay, if you're really going to commit to this, we'll double down as well and basically sell as much as we possibly can. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle. Abby.
Hey, Lisa. Well, we do certainly have a strong tone for stocks this morning after a brutal week, actually 3 weeks for stocks. But here we have lots of stocks higher. And one of the top story stocks on the day, Kellogg, up 5%. This as the company is breaking into 3 publicly traded companies. The largest will be Global Snacking, followed by the North American Cereal. And then Plantco, really following a recent trend of big conglomerates going smaller. Certainly good for the investment bankers, too. Speaking of investment banks, J.P. Morgan, now these shares had been down sharply last week, nearly up 3% today. This, of course, ahead of the Fed stress test. They are expected to be the largest returner of capital to investors, roughly $18.9 billion in buybacks and dividends if all goes well. Carnival bouncing back. The travel trade has been under severe pressure, but today we have some investors dipping a toe in. And then finally, with the rebound that we're seeing in Bitcoin, technically confirmed to go above $30,000 per Bitcoin, we have Coinbase Global in a nice rally, up more than 7% on the morning, Lisa.
Abigail, thank you so much. The NASDAQ resuming its bounce back after falling more than 6% last week on the Fed 75 basis point rate hike. Joining us now for more, our own Taylor Riggs. Taylor.
Yeah, Lisa, and you're right that Friday we started to build up some of the momentum. Even though Friday was a relatively good day, it was still sort of wrapping up a week of losses, as you mentioned, coming off Wednesday's meetings. So trying to at least today build on some of that, a little bit of the momentum that we had as of Friday. You're certainly seeing technology participate. A lot of people saying you really need that as some of the heavyweights in the index to participate. You're seeing that with Apple, of course, some positive news on the iPhone sales. The stocks index last week was off about 9%. So you're starting to see some of the chip makers come back today. Certainly good news. I have to talk about Bitcoin. We know that it doesn't stop trading over the weekend. It did briefly dip below 18,000. You're starting to get a little bit of that comeback. So right, blockchain, of course, participating in that just a little bit. I think what's interesting, and Romain hates when I do this on the close, I take a look at the equal weight index. He knows that things are really bad when I start to do that. But we've broken out the tech versus the non-tech in the equal weight. And you are starting to see some of those non-tech roll over as well. And that might actually be a sign of some of a broad-based decline, some of that full capitulation that a lot of people are looking forward to seeing before you can get a true bottoming out. So perhaps maybe actually a good sign that some of those non-tech heavyweights are also really starting to roll over as well. Maybe a bigger buying opportunity ahead. Finally, here you can see, just sort of recapping the big action on Friday, Lisa, is that tech was starting to rebound, right? But energy was really to the downside. Now, today, of course, we know everything's sort of a broad-based rally, maybe some signs that if this will stick into the closing bell, though a lot can happen between now and 4 p.m.
Taylor Riggs, thank you so much. Isn't that the truth? Sticking with big tech, Tesla CEO Elon Musk speaking with Bloomberg at the Qatar Economic Forum. Take a listen.
A year from now, I think our headcount will be higher in both salaried and obviously in hourly. But in the short term of the next few months, we expect to see, like I said, roughly a 10% reduction in salaried workforce, which is actually just really only a 3.5% reduction in total headcount, and not super material.
A sober and really kind of restrained Elon Musk. Ed Ludlow joining us now from San Francisco with more. Ed.
Yeah, good morning, Lisa. I mean, with his Tesla CEO Howell clarifying comments that he made in internal memos, he basically said that salaried headcount grew too fast, but he gave a really good picture, robust picture of demand for Tesla, saying that wait times are very long, demand, quote, remains extremely high, and you see Tesla stock pushing higher 5% this Tuesday morning. A really wide-ranging interview with the macro backdrop, Musk saying that a recession is inevitable at some point, in his opinion. Whether a recession or not happens in the near term, he said, is more likely than not. The other big topic, of course, was his deal to buy Twitter at $54.20 a share. He says there's, quote, still a few unresolved matters the proportion of users on the platform that are bots, whether they are less than 5%, as Twitter says, being the main sticking point. He's awaiting further details and clarification on that. Although what was really interesting is, once again, with such a forum, such an opportunity, he did not explicitly state that he intends to proceed with the bid, $54.20 a share, although Twitter shares also higher by around 1% on Tuesday morning.
Ed Ludlow, thank you so much. Morgan Stanley with also a pretty sobering view, saying that U.S. stocks need to fall even further despite this year's slump. Mike Wilson saying the current market, quote, does not price the risk of a recession, which is 15 to 20% lower, or roughly 3,000. The bear market will not be over until recession arrives, or the risk of one is extinguished. Kaylee Lyons joining us now for more. Kaylee.
Well, Lisa, apparently a 23% drop in the S&P 500 so far this year, and June isn't even over, is not enough to accurately price in the growth risks that this country and this market are facing. That's the thesis from Mike Wilson over at Morgan Stanley, who says stocks could drop another more than 700 points in the near term. And he's not alone in that. Goldman Sachs, Peter Oppenheimer over there, also said that only a mild recession is priced in at this point, which leaves the market vulnerable to a deterioration in expectations. All that said, Goldman still has a 4,300 target on the S&P 500 at year end. Morgan Stanley, Mike Wilson, has a 12-month target, so a little bit different, but he sees it at around 3,900. But Lisa, just look at where consensus is, 4617 on the index. That would imply about a 22% gain for the S&P 500. And you have the likes of John Stoltz over at Oppenheimer with a 5330 target, which would require a 45% rally over the next 6 months. So the gap in the range within forecasts is huge. Obviously, a lot of it ultimately will likely come down to the earnings story. Right now, second quarter earnings expectations are only for about 4.2% growth in profits, widening back out in the back half of the year, but still below those COVID peak levels. And Bloomberg Intelligence points out that you are seeing forecast revisions trending downward for the S&P 500 for each quarter until 2023, Lisa.
Kaylee Lyons, thank you so much. Goldman Sachs also seeing U.S. stocks exposed to more downside risks, saying, quote, while there has been a considerably derating and some markets are trading below average valuations, pricing is more consistent with a mild recession than an average or deep recession, leaving them exposed to a further deterioration in expectations. Kaylee, as you were talking about earlier, joining us now, Invesco's Kevin Holt alongside Julie Beal of Kane Anderson Rudnick, who is still with us. This has been an issue right now as we deal with the potential for recession. At what point, Julie, do you actually see the market pricing that in? Do you have a price point for the S&P?
We don't have a price point for the S&P, but we're paying a lot of attention to valuation metrics, right? And in a true, proper, deep recession, we should be in single-digit forward earnings multiples, and we're not there yet. And I think too, it's understanding the strength and durability of the earnings within the S&P. You have some sectors that are very exposed to major earnings declines, your deep cyclicals, and your deep value cyclicals, which have seen a really strong rally in the market. So I think they're major pockets of exposure where you could see big declines going further. So I think it really pays to be very choosy. I think it's a great time for active management because a lot of the market movements have been broad brushstrokes. So you can really find some good businesses here.
Kevin, are people too pessimistic right now?
I don't think so. I think you have, the Fed increasing rates for the first time in a long time. You have the end of quantitative easing. And multiples are about, if you believe the earnings of the market right now, about 15.5 times earnings. So I kind of think with our first rate increase just behind us, I think it's going to be a tough summer. And I think rates are going to continue to move higher throughout the year. I think we're likely to have earnings disappointments in Q2, which are going to create more attractive entry points probably later in the year, either Q3 or Q4.
So where's the value right now?
Well, and I think it's kind of interesting. It's most of us haven't lived through an inflationary environment, and I don't think the 70s are really even indicative of what we're at, because the 70s was mainly oil. So you have to go back to the late 1940s to where we have pervasive inflation, not only in oil but in food and a number of different areas. So I do think we're in an inflationary cycle. Personally, I think it's going to be here for a sustained period. I think wage inflation is something that will probably be around for a few years. Some of the other issues, oil, I think, we've restrained supply. This is not the same oil industry we've had. Demand is going to go down in a recession, but oil prices, like we had in 2000, $20 or even, the $50 level we've had historically, I don't think is going to happen again in the near future because this is a much better run industry than it's been in the past.
This sounds like a pretty pessimistic recipe, and every guest that we've had on this morning has had a pretty negative view in terms of where we could potentially be traveling. But Julie, other people point to the fact that you're actually getting yield for the first time, actual real yield, and 8.5% coupons on certain junk bonds on average. At what point do you start to ratchet up returns expectations because of the increased risk?
Well, I think it just depends where you're looking within the risk tolerance and risk appetite. So, I think because it's been broad brushstrokes in terms of what's sold off, particularly, let's say, in the tech sector, not all tech businesses are the same. There are ones that have, slower growing but very durable earnings that are well protected even in a recession. You look at a business like Aspen Technology, which even in the glut of oil prices was still delivering solid earnings growth. Those are the types of businesses that I think really can help you weather through the storm and also allow you to participate in the upside when we get to a recovery. So if you're a slow-moving investor like us and you just want to know your businesses really well, those are the types of businesses we're looking at right now.
Meanwhile, Taylor basically pointing out how much big tech has sold off, and bull's gonna bull. Wedbush's Dan Ives still being bullish despite the recent volatility in big tech, writing, quote, "The street is already baking in a mild recession into current tech stocks, and the risk-reward setup is favorable for our top enterprise plays." We could make any argument under the sun, but Kevin, do you think that there is a bottom starting to come in here given the cash flows and given how much these really do have incredible market share?
Yeah, and I think what we've seen throughout the year is, the first group that was shot was technology, and then financials, and then retail's had its issues. So I do think there's opportunities in tech. I do think a number of the stocks, much like 1999, that don't generate cash flow and don't generate returns on capital are not good investments. But I do think, and we've even added recently to some large cap tech names that have strong free cash flow yields, higher than the market, great businesses, great moats. And I do think those type of businesses are going to be what you want to add in this tough period. And we're going to come out the other side of this eventually. And I do think there's going to be some great values being created, just like there is at this point. You just have to be very selective and very patient.
Yeah, and that's actually something that UBS Stuart Kaiser noted as well in a note, basically saying it feels far away this week, but better second half outcomes remain possible. Talking about for tech upside, we still see a tradable window as core inflation settles into a lower month-over-month run rate over the summer. Do you agree, Julie, that does seem like a likely trading period? I know you're not into trading, but do you think that there might be an entry point, maybe, is the way to phrase it?
Yeah, I think entry points are always something we're looking at, right? For us as longer term investors, the declines that we've seen have actually been a nice breather. And it's sort of like a cleansing shower on these valuations because we had just gotten to a place that were completely unsustainable. What I would say about tech is that even good quality tech, you have to be a little bit choosy. And so do I want a lot of exposure to the US consumer or let's say the ad market, which I don't think is nearly as strong going forward as it has been? Not really, no. Even though these are really powerful businesses in terms of their duopolies, monopolies, I still think I would rather choose a software business that's serving other enterprises or other business communities. I think they'll be more resilient than anything that's tied to the US consumer.
Julie, thank you so much for being with us. Kevin Holt, we're sticking together for another at least 20 minutes, so sorry. Coming up, recession risks rising. Take a listen.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
That conversation's still ahead, and some people did not get the pessimistic tone, at least if you take a look at where stocks are trading, up more than 2% in the first 15 minutes of the open as people look to claw back some of the losses experienced last week. This is Bloomberg.
the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Talking to Larry Summers this morning, and there's nothing inevitable about a recession.
Homebuilders keeping a close eye on surging mortgage rates. Lennar Chairman Stuart Miller saying, quote, the weight of a rapid doubling of interest rates together with price appreciation began to drive buyers in many markets to pause and reconsider. We began to see these effects after the end of the quarter. Bloomberg's Michael McKee and Taylor Riggs both joining us for the data to watch this week and the broader market ahead. Michael, what are you looking at?
Well, let's take a look at the impact of those higher rates. Bankrate already has the 30-year fixed mortgage average for the country at over 6%, that coming in this morning. But it's not the 10-year note that necessarily drives it. You got to look at the Fannie and Freddie commitment rates. 5.46 is what they will buy a mortgage at, and that's what's key to you getting a mortgage. And you can see the impact on the white lines in the background. That's existing home sales. And when rates go up, sales go down. That's what's happening. This week, we get a number of numbers, including existing home sales at 10 o'clock today. They're expected to be down 3.7%, continuing their run lower. Mortgage applications on Wednesday, they popped up just a little bit, but not much. They've been going down as people pull out of the market. And then Friday, new home sales, they're expected to be marginally higher. But again, this is a declining market because it's the most interest rate sensitive. Now, the other thing that Lennar and the other home builders are worried about is what prices are. Do they price people out? Look at the solid lines. That's existing in new home sales going down. That's what's been happening. But look at the dotted lines. Those are the prices for existing home sales and for new homes, the median prices. They still keep going up, and that's what's feeding into inflation. Those have to turn around. The solid lines have to pull the dotted lines down in order for housing to stop contributing to the big inflation rise we've got.
Yeah, well, and Taylor, this goes to the home builders and the outlook for them at a time when there still is a lot of demand.
Spot on. I'm taking a little bit of a play out of Mike's playbook. Take a look at this terminal chart. I think Mike said it best, right? When rates go up, prices go down, new home sales go down, existing home sales go down, right? So that sort of is the classic correlation here that we're looking at. Mike McKee knows this better than I do, but arguably maybe this is actually what the Fed wants, right? Trying to cool off maybe a little bit of an overheated market here. And so that sort of is the basic supply and demand dynamics here at work. Take a look at year to date, some of the price action here of what's been happening to some of these home builders. Really tough, right? As some of the sentiment has rolled over on the fact that prices have been rising. We've talked a lot about the lack of inventory, some of the lack of affordability underway. You're off anywhere from like 42 to 44% year to date. So well into correction, well into bear market territory for some of these individual stocks. I liked Lennar, of course, because they're coming out getting a little bit of a bounce today and saying that, well, maybe this is a bellwether for the group. Maybe things aren't as bad as we think about sentiment, and finally being able to come back into that stock. Here's sort of a good key here, though, Lisa. Mike has been talking a lot about sort of the rising costs, the rising input costs. Lumber's coming down a little bit, and so what that means is, well, maybe some of the home furnishings are also coming down as maybe people aren't having to furnish some of those homes, but that could be good news when some of that high input costs like lumber are starting to roll over just a little bit.
Taylor, Mike, thank you both so much. Invesco's Kevin Holt still with us. Kevin, do you start to see opportunities when you see home builders beaten down to that degree and the fact that people still want to buy homes?
Yeah, I do think what's difficult right now from a stock perspective is we're fighting the fear of the unknown. And as I said, we just increased rates for the first time. So I think economic activity is going to slow, and it's going to slow probably over the next 3 to 4 quarters. So I think it's, ultimately valuation and risk return, but I think it's still too early. I think the housing market's been incredibly strong for a long period of time. And I think with some of these cyclical stocks, you have to be very choosy about what industries and how much demand elasticity there's going to be. And I think in housing, with rates going up like it has, I think housing is going to be in for a tough run for a bit.
Over the past decade, though, Kevin, a lot of the emphasis has been for shareholders, for some of these home builders to return capital, to be prudent, to not really develop as much as be profit generators. At what point does that become an attractive proposition at a time when you still have a dearth of homes relative to demand, at least according to many housing experts?
Yeah, and I think it's just going to be, I think the big thing to focus on right now is just how demand holds in there, because you're exactly right. It's a much better industry than it had been in the past. It doesn't have the boom bust cycles quite as much as it's had in the past, although it is, ultimately the demand of the consumer. And interest rates are, at 40-year highs in terms of housing affordability. So I do think we need to be cautious, but it is a good industry, and there'll be a time to own these stocks. The question is it in 2022, or is it more? We need to wait for the economy to kind of weaken in 2023. We can build positions here.
Kevin, before we let you go, I do want to get your take just quickly here on what kinds of margin pressures you expect. Kevin, do you think that that's priced in, or do you think that that's going to be a real pressure over the next 6 months for equities?
I think it's going to be a real pressure. I think some of the food inflation that we're seeing with the war, Russia and Ukraine, they're going to see increasingly pressure on food prices as we get into the back half. I think oil prices, hopefully, I'm not sure they'll go much higher. I don't think they're going a lot lower in the near term, but hopefully those don't get a lot worse. But then you have wage inflation, which I mentioned, and we see continued pressure on wage inflation, and we still continue to have supply chain issues. As long as China has a zero tolerance policy with COVID, supply chain issues are going to be persistent. So the combination of those factors makes it very tough for the rest of 2022. But I do hope as we get into 23 and lap some of these issues, that creates opportunity, and then the markets can rebound.
Kevin Holt, thank you so much for being with us this morning. Coming up, the market-moving events that you need to be watching. That's next in our trading diary as we try to claw back some of the losses from last week, up more than 2% just into the open. This is Bloomberg.
Diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Just taking a quick look at markets, you can see the NASDAQ really leading the way, up 2.6% as people perhaps try to find value after last week's 6% losses. Time now for the trading diary, what you need to be watching this week. Existing home sales coming at the top of the hour, followed by Fed speak from Barkin and Mester. On Wednesday, Chair Powell heading to Capitol Hill for 2 days of testimony. Plus, we'll also hear from the Fed's Evans and Harker. Another round of jobless claims, and the Fed releasing the results from its stress test on Thursday. And finally, new home sales, Michigan's consumer sentiment survey, the key one for the Fed, at least according to them. And the Fed's Bullard and Daly speak on Friday. This was Countdown to the Open from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And It's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing otherwise. for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data.
NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up a specific way, you don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb. But, if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around, Reddit, and its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
they're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all